Started. Good morning, everyone. Welcome to Pew and our event on student loan repayment. Who is struggling and what are the next steps? I'm Travis Plunkett. I direct Pew's work on family economic stability. Over the last several years, many of our staff have spoken to you in the audience, on the webcast, serving on our panels, about the new line of work on student loans that we've been developing and gotten your advice. In January, we kicked off this new initiative, and we appreciate you being here with us today for our public launch. Before I jump in and tell you a bit about our work and our panels today, a few housekeeping items. To the right are the restrooms. The men's restroom just before the elevator bank, the women's on the left just after. As our signs here say, if you'd like to follow us online, the hashtag is PewStudentLoans. We'll also be live tweeting. And for those of you on the webcast, you have questions for our panelists, please email them to studentloans@pewtrust.org. That's studentloans@pewtrust.org. A little background, and then we'll talk about the day. During the last decade, the amount of money owed on federal student debt ballooned from about $500 billion to over $1.5 trillion, now surpassing all categories of household debt except mortgages. Today, more than 40 million Americans hold student loans. Still, investing in a post-secondary education is usually a good deal. Previous Pew analyses, and there are many, done by many other organizations, indicate that individuals raised in the bottom 20% of the income distribution triple their chances of making it to the top 20% of the income distribution if they have a college degree. Most borrowers do successfully repay their debt, but the Department of Education tells us that just more than 8 million people don't. They're in default. They haven't paid on their loan in at least a year, and millions more are behind. They're delinquent. The consequences of default or delinquency on student loans are serious, and they go beyond the obvious issue of damage, further damage to a borrower's credit. It can include wage garnishment, tax return garnishment, Social Security garnishment, loss of driver's or professional licenses, and even ineligibility for additional student aid and for federal programs like those that promote home ownership. And of course, when borrowers don't repay their loans, taxpayers are affected. Successful borrowers not only protect their financial health, but also the federal funds that support the student loan system. Thanks to the research of a number of organizations represented here today, we know now a fair amount about which borrowers are struggling the most with repayment. And these organizations, I'll just mention a few who have led the way: Brookings, the Urban Institute, and TICAS, the Institute for College Access and Success. One key finding is that those who owe the least, often less than $5,000, default at higher rates than those with larger loan balances. Many of these borrowers haven't completed a program of study. Recent research also highlights that there are high rates of default among African Americans, those with low or volatile incomes, and those who attended for-profit colleges. High balance borrowers, who typically take out loans for advanced degrees that result in high earnings, often, generally, can face a different repayment problem. Even those who make payments on time may see their balances continue to grow if those payments don't cover the interest that accrues on their loans, trapping them in a long-term cycle of debt. While this research has helped identify who is having the most difficulty repaying their loans, there's still a lot of questions about why this is happening. Again, many of the groups represented here today are leading the way in helping us unpack this question, like the National Consumer Law Center, servicers, loan servicers, and higher education associations. But there's still much to learn, and that will be the focus of Pew's work. We're going to dig into the why through research, policy analysis, and advocacy. Sarah Saddlemeyer, whom many of you have met, is leading a project that seeks to significantly reduce loan default and delinquency among borrowers at highest risk of falling behind. To that end, they're going to conduct research on and, where warranted, recommend reform of two elements of the student loan system that are pivotal to borrower success: loan servicing and the loan repayment system. Phil Oliff is leading a research team that is digging deep into the causes of default, the challenges facing borrowers in default, and the procedural barriers that could be making it harder for borrowers to get and stay out of default. And while this isn't something that we'll talk about at this event today, Phil's team is also going to focus on understanding why some veterans are taking out significant amounts of student debt, even though they have access to generous educational benefits, such as the post-9/11 GI Bill. So this new Pew initiative will be grounded in our previous and ongoing work on consumer finance, family financial security, as well as the knowledge we've accumulated through research on the many roles that the federal and state governments play in supporting higher education. You'll meet Sarah and Phil later, if you haven't already, and they'll tell you more about their projects. So a couple words about today's event, and then we'll get going. We have three very interesting panels. We're going to begin with a framing of the problem, exploring in depth who's struggling the most with repayment and highlighting what we still don't know about why they're struggling and how they're struggling, from both the borrower and the loan servicer perspective. The second panel will focus on the last 2 decades of student loan policy with higher education experts who served in both the Bush and the Obama administrations, and also from the Wall Street Journal. Finally, we'll conclude with a discussion about where to go from here, including information on the PROSPER Act and proposals in Congress, other ideas for reform, the potential timing of that reform, and action at the Department of Education. As in the earlier sessions, we're asking all the speakers on this panel to focus on or consider the role of research in the policymaking process and where they think more information could move the debate forward. Okay, so I'll ask the first panel to saunter on up, and let me introduce our moderator. Come on, saunter. First in line, Kimberly Heffling, our moderator, senior education writer at Political Pro. Prior to joining Politico, Kim served as the national education writer for the Associated Press. During her 18 years at the AP, she also covered veterans and military home front issues and Pennsylvania politics. And most exciting to me, she was embedded in the 101st Airborne Division. Kim, I'll turn things over to you. Thank you.
Thank you. It's great to be here and get your questions ready because we will be opening things up to the audience in a little bit here. Let me first get started. I'd like to introduce Adam Looney from the Brookings Institution. We have Joanna Darkus from the National Consumer Law Center, and we have Deborah Cromie with the Education Finance Council. So why don't we just get started with a broad question. Who does struggle the most with student debt, and why do small amounts of debt trip some borrowers up? Do you want to answer that first question?
Sure. So I thought I'd start off just by saying first that not all borrowers do struggle. Most college students get a very good deal out of their college education, and a student loan is an excellent way to finance it. So the premium to a college degree has never been higher. Even during the Great Recession, the unemployment rate for college graduates never exceeded 5%. In recent work, Judy Scott Clayton looked at followed borrowers, or students rather, who had started school in 2004 and had tracked them over the course of the Great Recession. And she found that if you had completed a bachelor's degree and attended a public or a private nonprofit institution, only 5% of those borrowers had defaulted on the student loan over the subsequent 12 years. And in my own work, looking at those who defaulted in the last several years, I found that people who had attended even moderately selected public and private four-year institutions had default rates that are as low as they have been in most of the 80s and 90s. So a lot of borrowers are doing very well, and a lot of students have benefited from the loan program. But of course, we're not here to talk about those successes. We're here to solve some problems. So we talk about where the problems are. Well, so I'd say that the biggest group of people who struggle with their loans are what I'd call non-traditional borrowers. students who went back to school, perhaps later in life, pursuing a degree part-time rather than full-time, pursuing a certificate or an associate's degree or some other credential, but not necessarily a bachelor's degree. Perhaps taking classes online rather than in person. And over the last several years, in particularly during the Great Recession, there were a lot of people who were displaced in the labor market either because they didn't have the right skills or education. They went back to school. They disproportionately flowed into for-profit institutions and to a lesser extent, community colleges, and they borrowed to do so. And those types of borrowers have had particularly tough outcomes. So if you look at people who left school in 2011, over the next 2 years, about 30% of people who had attended a for-profit school or at a community college would default over those 2 years, compared to about 13% of people who had attended four-year schools. And those numbers probably understate the longer-term distress they'll experience. So Judy Scott Clayton's work suggests that about half of all for-profit borrowers will default over 12 years, roughly twice the rate at community colleges. And so beyond just the sector in which they went to school, members of minority groups default at much higher rates than whites. People who complete a bachelor's degree default at much lower rates than individuals that don't complete a degree or complete a certificate. And so the concentration of default in those types of groups is very high. I will just mention briefly that while those are the largest groups of people that default, there are people who struggle outside of those groups. So there are some graduate students and some parents that can accumulate very large balances that they will struggle for many years to repay. We have relatively little information on them, in part because the department doesn't usually publish information about the default rates of parents and graduate students, and in part because they don't default. They're enrolled in income-based programs that allow them to kind of persist without defaulting.
So I think there's a narrative in many people's minds that, and this played out a little bit in the 2016 presidential election, that there are vast numbers of students going to a four-year college, graduating, and then forced to live in their parents' basement because they had so much student debt. Is that narrative then wrong that many people have in their minds and that we saw discussed in anecdotes of news stories and in some campaign ads and things?
I mean, so I don't want to dismiss the challenges that some borrowers face, but by and large, those that attend a four-year school, graduate with a BA, they're taking on reasonable amounts of debt, and they are, by and large, succeeding in the labor market.
What do you think needs to be known when we talk about who's struggling the most? What do you see in your work?
As a legal aid attorney and now in my role representing individual borrowers at the National Consumer Law Center, I've dealt with a lot of folks who are struggling to repay because their limited means don't give them the ability to make their payments. Now, one of the things that became apparent to me very early on is that some folks have been in default for a long time, and they've been stuck in perpetual default because the more generous repayment options that are available now have not always been available. So I represented borrowers who borrowed loans in the 60s, in the 70s, in the 80s, in the 90s, before we had pay as you earn or repay or IBR. So the way that we're going from a policy perspective, where we're creating more flexible repayment terms that are really sensitive to the financial realities of borrowers, is incredibly important. And unfortunately, most of the folks who come into my office, most of the folks who sought legal assistance to resolve their student loans from me have come in because they're facing terrible, just devastating debt collection because they've already experienced default. So a lot of the work that we do is grounded in figuring out what we can do about the problem of default specifically and looking at low-income borrowers and the challenges that they're faced with. Some of those are going to be the same as they are for other borrowers, but we see that low-income borrowers, if they come from a low-income background or a low-wealth background, they're more likely to rely on federal aid to finance their education on the front end. But depending on what happens when they go to school, what kind of institution they end up getting tracked into, whether that's a for-profit school that's not going to deliver value, whether it's whether there's some reason that they get pushed out of their program, or whether the labor market just isn't a safe place for them, or they struggle with the kinds of persistent racial discrimination that is still apparent in our world. Those are some of the things that have the ability to sidetrack borrowers. And that means that if you don't have the ability to pay, if you don't earn the income that would make it possible for you to feed your family and also repay your student loans, and if you don't have good information about your options, then even having a small balance is going to trip you up, because we're also looking at how much of your income would you have to pay if you were to, dropped on the standard repayment plan and had to go from there. So some of the research that Adam mentioned highlights these groups of borrowers. Our clients are disproportionately women, they're people of color, and they're folks who were often the first in their families to go to college. And I already mentioned that many of them come from a low-income background. So all of those factors are very apparent to us when we're looking from, with our policy glasses on, at what we might need to do to address the real problem of default for far too many student loan borrowers.
And when we talk about small amounts of debt, sometimes we're just talking like a couple $1,000s. Is that what you're seeing? Or
some borrowers, especially those who don't complete their education, tend to leave their programs with small balances, and they could be less than $10,000. Some of the borrowers that I've worked with have completed their programs, but still not been able to earn the kind of income that helps them make ends meet and also make student loan payments. And I'd be remiss if I didn't mention the fact that some folks borrow, they get a great education, and then they have a change of circumstances, like they become disabled. And thankfully, there are some safeguards in the federal loan program that enable folks to discharge their student loans if they become totally and permanently disabled. But there are people who need to avail themselves of that option. Otherwise, they'd be under the debt forever. And I just wanted to highlight one of the strands of research that Adam mentioned. What we know is that there are real racial disparities in student loan repayment. Some of that has to do with the racial wealth gap, and that Judith Scott Clayton's research showed that even a bachelor's degree didn't insulate Black borrowers from being at the peril of the risk of default on their student loans.
do you have some thoughts on who's struggling the most that we haven't discussed yet?
Sure. So let me talk a little bit more from a servicer perspective. Education Finance Council represents nonprofit organizations that work, that are higher education financing organizations. So my comments come from that space. And a number of our members are servicers under the federal student loan program. And one of the problems that we see, or servicers see, is that when the borrowers come to them, the debt's there. So part of the problem really backs up, and we may talk about this in a minute, so I won't spend a lot of time on it, but at the beginning in terms of how much debt a student is taking out. So then when they get to the door and they look at the options that are available to help them, so let's start there, the complexity of the options that are available to help them. So there are 8 different repayment plans. And walking through and having someone understand the complexity of those, given their own individual situations and what they're dealing with, can be a tough process for borrowers to manage. Let's complicate that a little bit more by every year, if you're in an IBR program, you need to recertify, and making sure that you remember to do that. A number of our servicers see difficulties with students being able to recertify their loans. And there's been a push, and certainly we saw the Department of Treasury sign an MOU, I think almost a year and a half ago now, around finding a way to automate this process, and we haven't seen that happen. That continues to be something borrowers struggle with. Let's add on school closures. We've had some of those in the last couple of years. That population is also struggling to figure out how to manage their debt and how to figure out how they get any relief that's made available to them by the federal government. So there are a number, we could go on and list a number of other items, but there are all these things that then come to the servicer to try and figure out how they're going to help borrowers manage these. And it's complex, and it's confusing, and it's not easy.
Now, can you just explain what is the recertification process
Sure.
like for somebody? And you said it's something you have to do annually. Is that correct? Can you just maybe explain what that entails?
Sure. So the servicer does send out reminders to borrowers as that date is getting closer, but there is a population, and I apologize, I don't know the number off the top of my head, but it's somewhere in the 25 to 30% that do not recertify on time. And so what happens is if they don't get their paperwork in time or somehow they miss those emails or those communications, their loan payment, which might be lower under an income-based repayment plan, all of a sudden shoots up to, so let's say it was $50 and now it's $600. And if you're having that deducted from your bank account, all of a sudden, whoa, you go look at your bank account and say, what just happened to me? And then they have to go through a process of getting the paperwork in, and sometimes that can take 2 or 3 months. The servicers work with their borrowers, usually putting them in a forbearance, so it brings them back down into good stead so they don't have to pay that $600 monthly payment. But it's all reliant on the borrower making sure that they reach out to the servicer and work with them. And usually within less than 3 months, they're back in and they're recertified. But it can be a very annoying and frustrating process.
Is it a process similar to like filling out a tax return? Is that what it?
I don't think it's that complicated, but there are some steps that you have to go through. Okay. Yes.
Let's also just quickly tell the audience what exactly is a student loan servicer and why are they important to this process? Do you mind answering that question, and if you should have anything to add about that?
So a student loan servicer, and we'll focus on the federal loan program, contracts with the Department of Education to do the process of collecting payments, working with borrowers, counseling them on the options that are available to them, and helping them and taking phone calls and helping them through that process. So they are basically, again, a contractor with the Department of Education. They can't do any more than what they're contracted to do. So I will say that going back to a little bit of the previous question, sometimes borrowers will call and they'll be looking for a servicer to do certain things. But a servicer can't do those because they're not contracted. The regulations don't allow them. They're not able to do that. So the servicer, again, is a contracted organization with the Department of Education.
How important do you think the servicer aspect of this is? How important is that piece of the puzzle with the clients you work with in terms of the relationship with the servicer and working with the servicer?
Yeah, the servicer is the primary point of contact between the borrower and the Department of Education. They're the middle person when the student enters repayment. And that relationship, if it's solid, can help someone succeed through repayment so that they make every payment, they are on time with recertifying their income if they're on an income-driven repayment plan, and if they hit a roadblock, then they know that they can go to their servicer. We found that when the relationship with the servicer breaks down or when the contact isn't flowing for some reason, that can really create an impediment to borrower success in repayment. And some of our, by the time they get to me, most borrowers are already being contacted by private collection agencies. And for low-income borrowers, folks who are at or near, maybe just above the federal poverty level, usually for us, if someone's entered default, that signals a servicing failure. So we have to make sure that our servicing system actually serves the folks for whom we could even anticipate they might have a problem with repayment. So if you don't complete your education, then maybe you're going to need some help along the way to make sure that you can get into the kind of payment plan that would make your loan repayment obligations affordable for you. And so servicers play a vital role. And when I see a low-income borrower enter default, that usually signals to me that something happened in the servicing process that we could have prevented. And I think that that's a place we really need to focus our energy on, ensuring that people have the help that they need, the comprehensive counseling, that timely assistance, that paperwork isn't lost in the shuffle, all of that, so that they can stay current on their loan obligations.
Now, are some borrowers dealing with multiple servicers? Does that complicate things? I mean, how does that process work? And also, do you get to pick your servicer?
So you don't get to pick your servicer. Your servicer is assigned. For the federal student loan program, the Department of Education has made a concerted effort to try and make sure that for federal loans, a borrower has one servicer. But many times they have other loans. They have Perkins loans, institutional loans. They may have private loans. So in that case, you will have multiple servicers.
Right. I've worked with borrowers who had multiple servicers for their direct loans and for their old federal family education loan program loans. So I've worked with borrowers who've had as many as 3 servicers. Consolidation is one way that you can put all of your loans together with one servicer. You can choose your servicer after consolidation. That's a relatively recent development, but an important one. If borrowers get to choose their servicer, sometimes they get to build a better relationship with them. They believe in that relationship because they had some say in it, so that can help.
Do you have some thoughts about this discussion about the role of servicers and the importance of servicers?
So I was just going to offer a couple observations. So one is that I agree that it is too complicated, and there are kind of too many options, and it's difficult to navigate. And similarly, it is difficult for borrowers to recertify their income on an annual basis if they want to stay in income-based repayment. And so I think some of those things can be simplified, and some of those things can be automated. But as someone who kind of comes from a tax background, there are elements of how we report our income to the tax system, that we have joint filing, where a husband and wife will both report their income on a joint return. We have a lot of people who don't file a return at all, especially low-income borrowers, the kinds of people who are at risk of default. So in some of these things, it will be very difficult to automate those systems, and will always require people to be on the phone and to walk people through these processes to help them with the paperwork. So I think it's going to be a really critical element of the system for quite some time.
Now, student debt has long been thought of as a young person's problem, but we've been seeing since the Great Recession more older borrowers dealing with student loans. My colleague Michael Stratford just had a story about AARP has been more active on this issue because of that. How did the Great Recession reshape the landscape, and what are you seeing in terms of the demographics of borrowers, young and old, and how are their issues different? Do you want to start with that one?
Sure. Well, so I will say one thing, which is I think that there's an element of a statistical artifact in the sense that the Great Recession happened to coincide with the date that people born in 1950 turned 60. And I say that in the sense that the Higher Education Act was enacted in 1965. The first birth cohorts to have participated in the student loan program were going to college in the 70s, 80s. They were defaulting on their loans in the 70s and 80s. And as you said, those loans never go away. And so in some sense, it's people who defaulted on a loan in 1987 who are now 65 and who are now showing up as a 65-year-old with a delinquent student loan. So I think part of it is simple, the persistence of those loans over time. I do think that the demographics have changed as well. So many more people return to school later in life. They are more likely to borrow. And so we've seen the age of people who are enrolled in programs rise. And so I think that they are taking on more debt. In addition, there are people who take out loans for their children. And so that is another set of issues where people are borrowing for not just one children, but perhaps multiple children over many years.
Or grandchildren even?
I don't know how it works for grandchildren. But certainly for parents, they're able to accumulate fairly large levels of debt and relatively late in their lives.
And then the other thing is that with these income-based repayment plans and consolidation, you're now talking about, if you're talking about a 25-year repayment, and let's say you finish school or grad school or, in your 20s, you're now in your 50s. So it's just, I just think it's a norm now of this population.
Are you seeing borrowers coming in who, for example, are having their Social Security garnished because they're having issues repaying student loans?
Yeah. I took a look at my cases the cases that came into the legal aid office I was working in 2015. In that year, there were about 140 new clients who came in with student loan problems that we served, and 35% of those folks were in their 50s. And 16% were in their 40s, and 16% were in their 60s. My oldest client was about 95 years old that year. So in general,
Did the 95-year-old have student loans?
Yes, these are all student loan clients. And so the population that I've served in legal aid has primarily been people who are later in life, who are still struggling with student loan problems, whether they're from their own education or for the education of their family members. So most of those people will come in because they're facing wage garnishment or offsets of tax refunds or offsets of their Social Security, retirement, or disability benefits. those are pervasive problems. Thankfully, we had some tools to help us get people back on track. But to hear clients say over and over again, like, they're taking money out of my check, I'm just going to have to eat less, or I just can't fill my prescription, was devastating every time.
Let's talk about what we don't know. If the three of you had the opportunity to do your dream research project or read your dream research paper or have the government collect one set of numbers that you'd love to have, what would it be? What would the three of you like to see out there available about student debt that's not available right now? Do you want to start?
Sure. Well, so first of all, I think the government sits on a tremendous amount of information about who borrows and the performance of the student loan portfolio. So federal student aid, has all of the information on people who fill out the FAFSA, and then the subsequent performance, where they went to school, the subsequent performance of the loan. And so I think that, as a first step, it should be relatively easy for them to produce basic statistics about how the portfolio is doing today, how it's performed over time, how performance varies across schools and across demographic groups, across types of loans, not just undergraduate, but also graduate and parent loans, and measures beyond default to other measures of outcomes. I don't want to say that they're on the shelf, but man, those data are kind of right there and are the low-hanging fruit. In addition, for things like the tax system, if you wanted to know what would be the consequence of repealing the student loan interest deduction, you could not only get a score from the Joint Committee on Taxation or the Office of Tax Analysis of Treasury, a whole host of entities like the Tax Policy Center, the Tax Foundation, the National Bureau of Economic Research could tell you who would be affected, what are the characteristics of people who would have to pay the tax, how much revenue would be generated, a wide variety of information that is necessary to understand the effects of a policy change and what its consequences would be. We don't have that right now in the public sector. And so that kind of thing would be a project that I would love to see broader access to the data necessary to make it happen. And then finally, I would say that a lot of what we've learned in other areas from the census and at Treasury, for instance, have emerged through partnerships with researchers where they've moved into the offices effectively of those agencies and kind of get under the hood and are able to use the raw data and ask questions like, how does federal aid affect completion or enrollment? How does student loan affect later life outcomes and the ability to buy a home or to move out of your house? And so those are the kind of avenues I'd like to see, avenues of research I'd like to see more of.
How about the two of you?
I certainly agree with Adam, and I would say that for us, one of the things we really want to make sure that we have a handle on is some of the ways in which different groups of student loan borrowers have different experiences with the student loan system and with their institution that they attend. So segmenting the data by more characteristics about borrowers, especially by race, by gender, and by socioeconomic status, all of that kind of stuff, the more granular things, we really need more and more access to that kind of information. And thankfully, the Department of Education is providing more of it, but we still need the ability to gather more of it, and so more research can be done.
And I would agree with both of these. I think there is a lot of data at the department that I agree with Adam completely. If we could unlock some of this, I think the one that I struggle with quite a bit is understanding the PLUS loan program and the fact that that data isn't available, including what is the cohort default rate for that population. I worry about that program because loans are made in that program with very little check on your ability to repay. And so are those the people that are ending up, at the Consumer Law Center or struggling on the back end? Without having that data, we don't know how big of a problem that is. So that's like one sort of deep dive on getting access to that data. The other piece, and I mentioned this at the beginning, is we've never been able to crack the nut of how do we get, I'll say 18-year-olds to begin with, to pay attention and understand the obligation, to connect up what your income's going to be with the amount of loans that you're taking out. How do we get them? And then understand what that's going to mean from a lifelong perspective. Again, when they get to the point where they're done or they're ready to repay, there's nothing you can do about undoing that. But I think if we could figure out a way to crack that nut and get them to understand, that would be great. And then this is the other one I struggle with. The IBR program and loan forgiveness are great programs and great relief for borrowers. But I would love to understand what has been the financial impact overall in the Department of Education of these programs. And could that money have been used in a different way to help this same group of borrowers without putting them through all of the hassles that they go through? If they are, I don't know if you can identify who might be the ones that are going to be struggling, but is there another way to take that money and use it to stop the struggling from happening? I don't know the answer to that, but those are things that, I don't know, keep me up at night.
Yeah, I would add, I'm really interested in what we could do with the data as well. So once we have it, what might we be able to do with it? Part of what we've discussed on this panel is the ways in which student loan borrowers, when they struggle, face dire consequences. But there are a whole lot of players involved in the student loan space. So we evaluate borrowers based on their success in repayment, but we should also be evaluating for-profit institutions, for instance. We should also be looking at servicers, whether they keep people current. We should be looking at debt collectors, whether they push people further into default and increase their balance because they're there longer. So we, as a whole, need to look at the ways we can hold every person in the system accountable, not just borrowers, but all of the institutional players as well, the servicers, the debt collectors, the schools, so that we're making sure that it's not just borrowers who are on the hook when they bear the risk, all of the risk of the investment that they made in their education. If it doesn't pay off for them, then we got to look at the system we created.
There are a lot of programs available today to help borrowers repay their loans. Why do so many borrowers still default? Do you want to start on that one?
Well, I think, so I think first of all, the premise of your question is right, is that we do have programs now that should allow just about everybody to avoid default in the case of economic hardship or an adverse life event. I think the real challenge is more on the why can't we get more people to participate in those programs. And I think, from my perspective, I can tell you the characteristics of people who seem to not avail themselves of it. There are, again, people who have often attended a school that attended a program that they didn't finish or a program that didn't lead to a good degree. They often owe very small amounts. They seem in some ways to struggle in the labor market, but also to be dissatisfied with their education, perhaps distrustful of the system. And so I think that some of this is the human element of how do you get a borrower on the telephone if it takes 250 phone calls to reach one person. How successful are you going to be of convincing somebody that they need to change their repayment plan and to call and to fill out the forms with the IRS to get them enrolled in the program. So I think a lot of it is kind of at that, dealing with borrowers who are difficult to reach and who kind of don't want to be hassled even further by the servicers or by the loan program.
Yeah, I think the range of options we have reflects that there are a lot of different people who struggle with student loans, and the one solution might not fit all of them. If we want to simplify, it has to be to ensure that everyone who needs the help can get the help that they need. So the complexity can be a bear, but if it's necessary to make sure that borrowers have the options they need when they are engaged in fixing the problem, then I think the options are essential. And in general, I haven't had borrowers that I've sat down with and counseled about their options who leave too confused to make their next step and make a game plan. That's my favorite thing. When I sit down with student loan borrowers in general, we can make a roadmap for them to get from a point where they're in distress, they're in default, to a place where they're current on their repayment obligation, to the point where they've discharged their repayment obligation because there's some legal basis why they don't have to repay the debt. Or there's some light at the end of the tunnel for them. So I think it's really important that we have the options that will meet borrowers where they are. We can simplify if it's going to improve borrower success, but we shouldn't just simplify to make it easier for ourselves who are in the student loan space to navigate. It needs to be easy for students to navigate. So it can be as complex on the back end as it needs to be. It should be seamless for the borrower as they interact with it.
And I would agree with that. The program needs to be designed with the borrowers in mind, that they're the ones that need to be able to easily access this. I think the thing that concerns us the most is that population that defaults, the majority of them have never spoken to their servicer. Either they didn't finish school, they didn't get the education, they don't feel like they need to repay that debt, or they've got other issues going on in their family that this just isn't a priority for them, or they put their heads in the sand and just want it to go away and ignore the mail that's coming and just hope that it will go away somehow. And then they end up in default, and they end up talking to folks like Joanne. Again, if there was one message or one way that we could get across to them that there is a solution for them, there are multiple programs available to them, and just have them to pick up the phone and have that conversation with their servicer, I don't know how to get them to there, but that's what I think is missing.
If you're a typical borrower, at what point would you start hearing from your servicer, and how would you be contacted by them?
So you are contacted. So your institution, when you're leaving the school, there's an exit interview. We can have a separate conversation on the validity of exit interviews. But there is a communication about the fact that, especially if it's a federal loan program, you have a 6-month grace period. But your servicer is reaching out to you beforehand. They're reaching out to you even if you're late on that first payment. They're continuing to communicate with you. If you're on a cell phone, there are limitations based on federal regulations about being able to contact people on cell phones. That's been problematic, given that the majority of at least this generation only has a cell phone. So a lot of the communication is via email or through regular snail mail.
All right, let's open it up to questions. Does anybody in the audience have a question for anybody on the panel? Okay, go ahead. Maybe state your name first, please.
Okay, I'm Frank Bowman with the National Association of State Student Grant and Aid Programs. So 50 states, 50 different approaches. So call us laboratories of democracy. I think there's 2 problems you haven't really addressed here relative to student loans. The first is entrance counseling. Because essentially entrance counseling is click through some screens and you get a loan. A couple of states have had programs that had tests at the end of entrance counseling to make sure you actually paid attention. Yes, this is a loan. What's your interest rate? What's your monthly payment? Who's your servicer? Those states had 1 to 0% default rates. Senator Harkin introduced the Smarter Borrowing Act, saying let's have verification of comprehension at the end. Now, at the back end, after default, most students, as you've indicated, didn't complete and have low balances, but they've also lost their eligibility for federal student aid when what we really want them to do at the state level is go back and complete. So, to me, there's 2 problems. You have to fix entrance counseling, and you have to have a process to get students back on the road to completion.
Do any of you have any thoughts on that topic?
I would agree with the entrance counseling piece, and there have been a number of studies that have been done. Trellis out of Texas did a study recently with actually some recommendations as to how you might improve the entrance counseling piece. I know that was forwarded to the Department of Education and I believe shared with members of Congress as to how you might improve that process. But I agree with Frank, the ability to get a loan on the front end with very little counseling is problematic, as it is on the back end with the exit counseling. Both of those, I think, are very problematic.
So I would say I agree that information needs to be made available to students before they borrow, to folks as they're trying to decide whether to invest in college. And information needs to be provided on the back end as well. We have to make sure that the information is timed appropriately. We know that disclosures, giving folks information at the wrong time isn't going to help them resolve their student loan problem. I don't know about you all, but I know when most people borrow, they believe they will get the job that will help them repay. When they borrow, they believe that they're going to finish their program and they're going to get that piece of paper that's going to qualify them for the jobs that they always wanted. So people borrow anticipating they're not going to run into problems with repayment, that they borrow anticipating they're going to complete their program. So giving them the information on the front end is useful, but we've got to make sure they get the information on the back end when they hit the road bump that they didn't anticipate. Do you want to I have another point. But
Yeah, I just want to add in, there's also been legislation that's been introduced, which I really like, which also says that every year, and I think there have been studies at institutions, I think it was Indiana University, where you remind everybody every year of what you've borrowed, and if you continue to borrow at this level, here's what it's going to be. And by the way, here are the jobs. If you're going to be an engineering major, this is the starting salary. I'll pick on Indiana again, in Indiana, so that people can actually see what that means. And I like this idea of having a reminder every year. A number of years ago, and I'm dating myself, before the master promissory note, you had to apply every single year for your student loan. And that was a reminder point for you. We lost that when we moved to the simplification of a master promissory note. And as Joanne said, building it so it was easier for institutions and for us to administer the program, as opposed to what is in the best interest of the borrower. And so I'm not saying do away with the master promissory note, but I do like the idea of somehow on an annual basis, at a minimum, revisiting with borrowers what they've borrowed, what that could mean for them as they go along their path. Thank you.
So, and for different borrowers, they're going to borrow different amounts for different reasons. So I also want to point out that one of the reasons that students don't complete is sometimes because they underborrow, and I don't want us to lose sight of that. Borrowing less isn't necessarily the solution. We need to make sure that people who are taking on the amount of debt that's appropriate for their financial circumstances when they enter, and that's going to set them up to succeed in repayment afterwards with whatever their job market is. So that means that maybe we shouldn't saddle low-income students with so much debt on the front end as one of the policy matters. But to also think through, when we think through default, we've just got to make sure that it's really easy for folks to get out of default, because default doesn't serve anyone well.
Can I just say that I agree with the premise, which is that a lot of the problems that borrowers experience are kind of totally predictable on the front end, where we offer people loans for programs that really have no chance of leading to a good job, programs people can't finish, programs and institutions with extremely high default rates. And we know that information on the front end. It's often very easy to anticipate that up front. So, counseling or some information, maybe that would be helpful, but I feel like when you're going in there with saying that this is a federal program and this program is authorized to borrow, gets the stamp of government approval on it, I think it's hard to disentangle that information or just a disclosure-only regime from something that actually says at some point we're just not going to lend you money to go to the school because a large number of people drop out or don't pay their loans or don't get good jobs. And so I think it has to be much more forceful if it's going to be effective than just a disclosure-only regime.
Right, yeah. I think disclosure is only useful when it's coupled with accountability and enforcement. So we have to make sure that we're holding schools accountable if they're not delivering value. Those schools are taking the taxpayer dollars. Those schools keep going on when students are in distress. Or they close their doors, leaving more students in distress. We've got to make sure that we're holding schools accountable, so we're cutting off those schools from federal student aid if they're failing to deliver the kind of education that sets up their students for success in repayment.
So that was another question I have, is who would provide the counseling? Would it be the school, or would it be, is there somebody else who should be providing this counseling? Is there a model one of the three of you like that you think works? Or?
So my sense is that there are programs that work, and so I think that certain state systems, I have not thought about it in a while, but certain state systems have pretty good informational systems where they know a lot about the student. They know when they're going to the community college. They have a good sense of which programs lead to good jobs. They're effective at sitting down with people and steering them into programs that do lead to good jobs. So I think that there are some places that do it well and where it can be an effective way to improve people's outcomes.
So I'll add, EFC, as I mentioned, represents nonprofit, state-based entities across the country. Those organizations have been working very well within their communities to do outreach to families to help them figure out how to pay for college, how to look at award letters, how to select a college, all of that. Some of them have offices in shopping malls. Some of them go out and do high school nights. Many of them have open door policies where families can come in and sit down and talk with them. And they used to work quite a bit on going into college campuses and actually being there on Accepted Students Day and actually being an independent voice, not the institution, talking about how, what are the options that are available to pay for college. There have been some regulatory restrictions that have limited their ability to do that, over the last 10 years. But that was very successful 10 years ago, and they're starting to be able to do that more and more. But I think it always goes back to how do you get in front of that family and have them think about this whole, and it is a family conversation, not just a student conversation as to how you're going to pay for college and where you're going to go to school and making those decisions and thinking not only about going to college, which is very exciting and has emotion. If we're talking about the 18, 17, 18-year-old, we're talking about a very emotional decision about where you're going to go and spend your life for the next 4 years. And are you going to be comfortable? And is it an environment that, big school, small school, all of those conversations need to take place. But also thinking about, and some people don't know this going into school, what it is that you want to do when you get out on the back end. And thinking about where you're going and how you're going to pay for it has to be connected in some ways to what's going to be on the back end. As we look at how this, the workforce is changing, and if you look at AI and how jobs are changing, there's a real probability that the job you might want to do when you enter school may not exist anymore when you get out in 4 years, and it may have changed. And I think we are looking at an increasing period of adult retraining and thinking about school not as a once and done, but something that people are going to have to do over and over again. And we need to think about the financing ramifications of that overall.
And we have a question online that was submitted. Several panelists have suggested that borrowers with certain characteristics, like those who drop out of college, are more likely to default on their student loans. How does the Department of Education prioritize outreach to vulnerable segments of borrowers, or provide servicers incentives to reach out to these borrowers? Or are all borrowers treated more or less the same in repayment?
Deborah, do you want to answer that one? Do you know?
I actually don't know the answer to that. I apologize. I'm not going to make something up. But we have a couple servicers in the room. I don't know if they would be willing to share their thoughts.
From Mohila. The metrics that the department issues is one incentive that servicers have. So there are a number of measures that servicers adhere to when managing the portfolio, and in order to get a higher ranking or score, then we're incented to make sure that we focus on portions of the portfolio that are struggling, that might not pay on time, or that might have a tendency to be delinquent. So we're incented based on the scoring mechanism as well as through other tracking and measurements that the department performs.
And Will, do you know who hasn't completed when those loans come to you as a servicer? Do you know who hasn't completed versus who has completed school? Does that information come to you?
No, we get just a separation date. So we know that someone, now we usually, there is a qualifier that says they've graduated or they've separated. Now, if they've separated, they could transfer to another institution, especially in the Northeast where you've got schools very close. You'll see students hop from one institution to another. If it's a more rural institution, odds are they may have withdrawn and maybe not completed a program of study.
And do you treat those that have separated differently than those that, say, graduated? Do you do any special outreach? I think that's where the question is going.
Not unless the loan starts to go delinquent. There is, because some students separate, it could be an adult who wanted to take 3 classes to change their, or returning to school person. They just needed 4 classes. They took the 4 classes and they're done. So we won't kick in until we either see a repetitive behavior pattern of delinquency or until the loan actually goes delinquent. And delinquent can be 1 day late.
I think we have time for one more question.
I'm
sorry.
I just had a quick response. So I think what we're hearing is that there's an opportunity for the Department of Education to provide incentives to servicer to segment the population of student loan borrowers when they enter repayment. create incentives for servicers to treat different student loan borrowers differently. I talked about preventable defaults and perpetual defaults, but these are predictable defaults as well, and that they're a subsection of the preventable defaults. So if we anticipate that someone's going to struggle in repayment, then we should be able to get them the kind of service they need so that we can smooth that path for them, and that's not their hardship to bear.
Do you have some thoughts on that?
So one observation was just in the data, my recollection is that schools did not have a strong incentive to report that somebody had graduated or had separated. And so most just, reported separated. I think that changed with the development of the college scorecard, for instance, where now that the Department of Education publishes some of that information, it became more of a high stakes issue for schools, and now they're starting to report. So there are kind of more of these analytical or data pieces that are going to be available, and it sounds like they might be useful.
Yeah, we definitely need more data on folks who don't complete and folks who are have more non-traditional characteristics. So like for folks who aren't first-time full-time students going in as well.
I think we're running out of time. Do each of you have some thoughts that we didn't address today that you'd like to discuss quickly, or any closing thoughts about this issue?
There's one other population that I'd like to mention that I think is struggling or having difficulty, and it's tied to the income-based repayment plan. And that is those that end up in negative amortization. So end up in a repayment plan that doesn't cover the interest that's accumulating on their loans. I have heard individually stories of people who have gotten into an IBR, feel like they're in a good place. A year later, they get their statement, and they owe more money than where they started the year. And that's really frustrating to them. So I don't know what the solution to that is. I know that if we make them pay the total amount of interest, that's problematic for them being able to afford their payment. But I think it's an issue that we do need to take a look at, because that's also when I see people sort of give up and say, why bother? Why bother? I'm never going to be done with this. I'm never going to pay off this debt.
Yeah. I agree. We definitely need a light at the end of the tunnel, and we need to make sure that income-driven repayment plans are available for all borrowers, including those Parent Plus borrowers that you mentioned, and that these plans really do set people up to succeed in repayment and move on with their lives so that they're not in repayment forever. Finally, I just mentioned that while we're dreaming big or thinking about unsolved problems, we really need to look at the consequences of default. It's far too easy for folks to enter default, hard to exit, and the consequences once you're there are really punitive. And that's demoralizing for a lot of people and prevents them from turning things around and getting the help that they need. So I really think we need to take a hard look at what we put people through when they do enter default.
Do you have any parting thoughts?
No, I mean, I go back to where I started, which is, we talked a lot about the problems in the student loan system, and it is important to recognize that college is a great way to move up the economic ladder. It is one of the most valuable investments that young people can make. A student loan at a quality school is an extremely good way to finance an education and to get ahead. So I don't want it to be to end on a negative note. I want it to end on a positive note that really it is a very good investment, and we should really work to make sure it persists.
Yeah, and that it pays off for everyone.
Pays off for everyone.
Right.
Yeah.
Thank you.
So we now have time for just a short break. I think there's still snacks and coffee, so please take about 5 minutes, during which you can and should still be tweeting. I've been told by someone who's much more technologically savvy than I am that we're trending in DC on Twitter. So I'll call you guys back in about 5 minutes, and if we could have the second panel come up to the front here to get mic'd. So as Travis mentioned, over the next 4 years, Pew is going to be engaged in 2 major pieces of work around student loans. My name is Sarah Saddlemeyer, and I'm leading the team that's focused on the policy and advocacy piece of this work. My team seeks to promote successful repayment of student loans among those most at risk of default and delinquency. And to that end, we'll conduct research on and recommend reforms to 2 aspects of the student loan system that are crucial for borrower success: student loan repayment and student loan servicing. Later today, you'll hear from my colleague Phil, who will dive into our research initiatives. The student loan repayment system is a maze, complicated to navigate, and this complexity can be disastrous for borrowers, as you heard from some of the folks on our first panel. It makes it difficult for them to choose and remain in a program and a plan that best supports their chances of long-term repayment success. For example, income-driven repayment requires borrowers to reapply yearly, and if they don't submit the required paperwork, or if their paperwork isn't processed in a timely manner, they can be removed from their plans and their monthly payments can skyrocket. In addition to the complexity of the repayment system, as you also heard in our first panel, the current servicing structure doesn't always effectively help borrowers understand and identify the best plans to support their long-term repayment success. Federal and state officials, folks from the Department of Education, and servicers have all identified issues with the current system that include errors in processing payment, low compensation for helping those borrowers who struggle the most, and challenges providing effective servicing in the context of an incredibly complex repayment system. Travis in the first panel outlined those who are struggling the most with default and delinquency, and more can be done to help get these borrowers back on track. Over the next 4 years, Pew will help stakeholders and policymakers craft effective solutions to ensure that our repayment system is affordable and flexible for borrowers, simple to access, and easy to understand. We'll also reach out to loan servicers, institutions, lending experts, and others to help them think about and to help us think about solutions that make that more likely that at-risk borrowers will enter successful repayment. So I'd now like to turn it over to our second panel by introducing the moderator. Adam Harris, directly to my left, is a staff writer at The Atlantic, covering education. He was previously a reporter at the Chronicle for Higher Education, covering federal higher education, historically Black colleges and universities, and higher education in general. So I leave you in his very capable hands.
Thank you. Good morning. So we've heard, who struggles the most to repay and who struggles the most with debt. But now we get to make you the smartest person at your cocktail party by learning a little bit about the history of some of these policies and how they came into effect. So we have a great panel. We have from my left, Cheryl Oldham, who's at the U.S. Chamber of Commerce and formerly Chief of Staff to the Undersecretary of Education in the Bush administration. We have James Kval at the Institute for College Access and Success and formerly Deputy Director of Domestic Policy under Obama. And Josh Mitchell, who's been able to cover it all at the Wall Street Journal. So first, we're going to start with the Bush administration. So Cheryl, can you just kind of give us an overview of what you all were thinking about and what and how you all were thinking about student loan repayment and management of student debt?
Sure. Listening to her talk about how, am I on? I am. Makes me think, gosh, now we get to take the blame for all of this, right, James? I think it goes way back before us. But thank you for allowing me to be here. And it was a great excuse to sort of go back and relive it a little bit. I blessedly tried to forget a lot of it. But I think it's useful to start, at least for us in the Bush administration, this was one of the roles that I had there was as executive director of the Secretary's Commission on the Future of Higher Education. And so that was a year-long look with about 19 of a very diverse group of commissioners from higher ed and business and nonprofit and K-12 and policymakers. And we spent a year sort of looking at higher ed writ large, but we also really dug into the affordability question, which then obviously impacted as relevant to this conversation. And so I was going back, and this was a great excuse to reread A Test of Leadership, which I brought with me, which is my only copy left. But I thought it would be useful, because this was 12 years ago that we released this report. And it feels like we're having the same conversations. So a couple of the interesting sort of findings, our higher education financing system is increasingly dysfunctional. State subsidies are declining, tuition's rising, cost per student increasing faster than inflation or family income. Affordability is directly affected by a financing system that provides limited incentives for colleges and universities to take aggressive steps to improve institutional efficiency and productivity. Public concern about rising costs may ultimately contribute to the erosion of public confidence in higher ed. And then this one I thought was interesting as well. The entire financial aid system, including federal, state, institutional, and private programs, is confusing, complex, inefficient, duplicative, and frequently does not direct aid to students who truly need it. So this sort of exercise, or this time we spent, really kind of laid the foundation for some of the then next sort of steps that the Bush administration took, which specifically, really increasing Pell Grants, cutting some of the servicer subsidies, the lender subsidies, and some other things. It was really, we really wanted through the commission to come out with recommendations that would really have Congress and the administration think about how to really shift the federal financial aid system and make it less confusing and complex and duplicative. I think that's just really hard, and I don't think that we've made many steps since then, and probably made it even more confusing and duplicative.
So James, you all kind of picked up the baton from there. Can you kind of give me, how you all were thinking about it when you were coming in and saying, okay, this is the complex duplicative system that we have. How do we fix it?
So, student debt and college costs were a priority for President Obama throughout his term, and I think in part he had the economic team telling him that higher educational attainment was key to shared prosperity, stronger economic growth. He also had a steady stream of constituent mail. I don't know if it's because the people who work in the correspondence office are not demographically representative, or maybe they are, but there was a steady stream of letters that he was receiving on people struggling with their student loans. And he said, to us at one point that he felt like student debt was a psychological weight on the country that was making young people feel like they couldn't have a fresh start in their life, that they already were starting behind the starting line, and made parents feel like they couldn't give their children the educational opportunity that they had had. Our strategy, I would say, was really in 3 parts, and we can talk more about it, whatever you're interested in. One part was we were trying to improve financial aid in order to bring down the cost of college, and so we made very large investments in Pell Grants, the American Opportunity Tax Credit, together that essentially doubled the federal investment in scholarships, something like $20 or $25 billion a year. So it's a very large amount of money. And some of that was funded through reforms to the student loan programs that reduced the subsidies we were paying lenders to make those loans. The second big set of things was reforms to the student loan programs themselves, and we worked very hard to make student loans more affordable, cutting student loan interest rates, and of course creating several income-driven repayment plans, which gave students the opportunity to repay their loans as a share of income. And that allowed us to say to young people, we think student loans may be one of the best investments of your life, but you know what, if it doesn't work out, if you have a medical issue, if you're unlucky in the job market, we can guarantee that your student loan payment will be affordable to you. And then the third was we took some specific efforts to address the lack of value at particular institutions. And probably the most prominent and controversial was the gainful employment rule, where we tried to identify occupational programs that were leaving students with very large debts and low incomes. Of course, that continues to be a debate that we're having today, and maybe we can talk more about that. Another example of that would be the college scorecard, where we produced the first ever national reliable data on employment outcomes, improved data on typical student debt burdens to help students make informed choices. So we felt like that combination of greater information for students, for college leaders, for policymakers, as well as some minimum standards in the cases where programs were clearly not serving students well was a good approach. So that was our strategy: scholarships, more affordable loans, and then some greater accountability for the lowest value programs in schools.
And Josh, you've had the opportunity to kind of survey this from the outside and even getting some inside knowledge. But tell us how was this seen? How were the moves seen from the Bush administration through the Obama administration up until this point?
I think with higher ed and the student lending system, each piece sort of makes sense. But I think when you put them all into one picture, a lot of bad things happen. And so one example that I wanted to address is income-based repayment. I think people from both sides of the spectrum think that it makes sense. It's kind of, and I think when they think of it as an income share agreement where you say, what James just said, it sort of takes away the risk. If things don't work out, then you only pay 10% of your income for 10 years. That makes sense to a lot of people. But then when you have, on the front end, the education department issuing a blank check and saying, borrow whatever amount you need, and I'm referring mostly to grad students and parents, but even on the undergraduate level, borrow as much as you need. And then on the back end, say, oh, we gave you too much, so therefore you don't have to pay it all back. And so as a reporter, I love being a reporter because I get to sort of take all of the interesting think tank pieces that Pew puts out and other groups put out, and then actually get to talk to people and learn, why they made the decisions they made. And IBR is influencing the decisions they made. I wrote about a guy who had $1 million in student debt recently. He was an orthodontist. He went to USC, a very good, prestigious private school. And I asked him why he got into so much debt, and one of the reasons why is he goes, because I became aware of income-based repayment, and when my debt got to be $300,000 or $400,000, I didn't worry about it. And I continued to go to USC for 7 years because my whole plan was to go into IBR. And then when I talked to the dean of USC, he says, look, I don't worry about what the costs are. My job is to provide the best experience I can here. I said, well, are you worried about students taking on all this debt through Grad Plus and taxpayers having to forgive some of it? He goes, no, I'm not aware of these programs. He goes, I'm just trying to provide the best experience I can. I'm competing against NYU, and that costs money. And so IBR, I think, in and of itself makes sense, but when you combine it with such loose lending, there's no underwriting standards. These schools are getting a ton of money from these programs, and talk about lack of accountability. And the first thing that these schools tell me is, well, our default rate's low. Well, their default rate's low because people are going into IBR, and sometimes, with IBR, you can pay $5 a month. So to get back to your question, I think whether it's the Bush administration or the Obama administration, they did their own things to try and expand access, and there were good intentions. But all these things happen piecemeal, and I think a lot of times it's just a Band-Aid on a broader problem, and each administration and Congress sort of avoids dealing with the hard issues and just tries to put a Band-Aid on it.
So kind of a lot about IBR there. So let's kind of talk about how IBR, income-based repayment, came into existence. And I wanted to go to you first because during the Bush administration, the College Cost Reduction and Access Act is kind of like the precursor to the current form of IBR. So can we kind of get your thinking on what was the discussion around income-based repayment and kind of how that came to be?
I mean, I think it's exactly, what Josh said is very much an interest in this issue of access, increasing access, and understanding that we had a real affordability crisis around higher education, which we still have today. And I think, when I referenced I think at the time it was a historic increase in Pell Grants, but one of the things the commission said, and it's just hard, I think, to do, is it wasn't just about increasing the Pell Grant, it was increasing the purchasing power of the Pell Grant. And the only way you can increase the purchasing power of the Pell Grant is if you then also, if tuition doesn't also increase at the same time. And that is a really hard thing. And I think, where do you want the federal government sort of in this situation of dictating costs around higher education or having some role in sort of setting what, cost of higher education is. It's a really, I would submit the higher ed lobby would come out in full force to not allow something like that to happen. So I think, we were very interested in how do we address this affordability issue and the issue of student debt certainly as well. And it seemed like, as Josh said, I think you have to look at all of these things together, which, I think we tried to set a path through the commission about how to look at all of these things together, but very hard then to actually go forward and address all of them together. And I think he's right. I think good intentions and then built on more good intentions by the Obama administration and a lot of the same areas that we started with.
Yeah, and as you mentioned, kind of building on some of those good intentions, the Obama administration, gave more borrowers access to lower monthly payments, and IBR. Can you kind of talk about some of the shifts there?
Yeah. So, I think at the time the administration began, we thought of the IDR program as one that had potentially great promise that had been underutilized. And the first version of the program began in the mid-90s and was very complicated, was very, very, very few people used it. It had been expanded by Congress under the Bush administration, was still used by very few people. And we saw this as a tool that had the opportunity to deliver student loan relief to the people that needed it most, more targeted than a student loan interest rate cut, for example. Had the benefit of having this insurance likes feature, had a benefit of expanding people's career opportunities. And so that was, what led to the president in the 2010 State of the Union calling for an expansion. And it was enacted only a couple of months later as part of the healthcare reconciliation bill. And, sort of over the course of the administration, we came back to that several times and expanded that formula to additional groups of students. We included some additional reforms to target the benefits and began to work much harder on the implementation issues than we did initially. And, we're able to, over the course of a couple of years, get enrollment in the income-driven plans up from several hundred thousand to something like 5 million. I think it's 6 million now. So, I do think that is one lesson that we learned a little late, and I wish the previous panel could have sent a memo back in time because being policy people, we kind of focused on policy solutions, and perhaps should have paid a little more attention to the implementation of it all. I also wanted to comment on Josh, who I think raises a really interesting point. I thought his article was really interesting, and I think he does raise an issue that should be addressed. But I think it's important to keep it in perspective too. The vast majority of people struggling with their student loans are students who have small loan balances, who aren't able to complete, who are marginally attached to the economy. Those are the types of students for which the student loan safety nets are intended. And so we do need to think about the edge case that Josh has identified, but we don't need to overreact. It would be a mistake to call into question the value of these safety net programs more generally.
And so, Josh, there, of course, are always spots where you can sort of see, okay, maybe this may have an effect that we're not looking at right now. What are some of those spots over the course of the previous two administrations where it's kind of been like, okay, maybe we need to put a additional safeguard in place here to say that borrowers can't take up to $100 or $1 million in student loans, and try to make sure that we're targeting the group that most needs these sort of safety net
I think one of the things that the Bush administration did, and I didn't cover the Bush administration early on, is they sort of eased the rules on incentive compensation, where it sort of allowed schools to, pay recruiters, based on how many students they recruited. And I think that had certain perverse consequences, particularly in the for-profit sector, where it expanded access, but it also expanded access to schools that ended up having very bad outcomes. I think one of the other things is that occurred with grad student debt is Grad Plus. Congress passed Grad Plus in 2007 or 2008, and that pretty much gave students a blank check in terms of how much how much debt they could take on. I wanted to address what James said, because I think it ties into this bigger question of, if you pay too much attention to people with big student debt burdens, whether it's $100,000 or $200,000, you're sort of missing the broader issue. I think what we've lost sight of is it's not necessarily that those students are struggling. It's that there's a lot of money that taxpayers are sending to these schools, and that has consequences down the road. It increases inequality. For example, it allows institutions to raise their prices, and I think that discourages a lot of students from then going to those institutions or from going to higher education in general. So when I wrote my story, in this particular case, my intent wasn't to portray people with high student debt burdens as a victim. It's to show that there is a very inefficient use of taxpayer money in higher education right now, and that is going to have consequences down the road. It's going to have consequences for taxpayers. It's going to have consequences for people from poor households who want to go into higher education, who are dissuaded from going to higher education because the costs are so high. And I make the comparison to healthcare. A lot of times I have people ask me, is there going to be a student debt crisis like the housing crisis? And I think there are parallels between those two. But I actually think what's happening right now is it's becoming like healthcare, where it's just sort of this weight on taxpayers. It's a weight on the economy. And there's not really going to be this flashpoint, I don't know, of where there's going to be this crisis. It's just growing and growing and growing. And we sort of ignore these problems that are happening under our eyes because we don't want to address these bigger issues. So I hope that answers your question. That was kind of a convoluted answer, but yeah.
I was going to just piggyback on that a little bit, and the previous panel talked a little bit about it too, but I think anytime you have this conversation about debt or financing, without also having this conversation about quality and student outcomes, it's just half of a conversation, and it's actually not that useful. So there has to be both of those things together. And, I think there are certainly things that Congress could do. There are things that we tried to do in the Bush administration and got shut down, very quickly. Unit record, having some level of data and transparency for the consumer around outcomes, any focus on outcomes, frankly. Just talking about outcomes, it was like, you're trying to make NCLB for higher education. Shut it down. We were trying to get a little bit of transparency around transfer credit policies and things like that in the higher education realm. Shut down. Anything around accreditation and outcomes, shut down. And so I think, you sort of do what you can do, and I think we were sort of addressing half of the issue, where we were trying to address the other half too, and we're just, unable.
Cheryl, kind of coming back to you and shifting gears a little bit. Talking about private loans, so not just the federal student loan portfolio, but also private loans. Kind of want to get a little bit of backstory about how you all were thinking about private loans, and then also private lenders in the federal programs.
Sure. I think, it's no secret that we were supporters of the FEL program, and we're not, pushing to move to, the federal government direct lending for everything. That was, pretty clear. We believed in of having the private sector involved in the federal loan program. That obviously changed under the Obama administration, and so.
I guess, yeah. My question is kind of like, why did you find it? Why did you believe that it was important to have private lenders involved?
I mean, I just think that I think maybe it's just a sort of a fundamental philosophical difference between feeling like the private sector can ultimately do a better job in certain areas than maybe the federal government can, and shifting everything from or the vast majority of private sector involvement to the federal government doing all of this themselves. I think we had reservations about and felt that private lenders were actually in a better position to do better by the customers that they were serving. I think it was more of a philosophical, probably, difference in those two things.
And James, you guys didn't have those same reservations. So can you kind of talk about the shift from FFEL to direct lending?
Sure. I think for us, there was a long-term reason and a short-term reason. And, I think many folks that worked in administration had felt for a long time that the student loan program working through banks was unnecessarily wasteful, that it was not a true private sector program, in that lenders were guaranteed against default. They were paid a guaranteed return that was in excess of the market rate. And there wasn't, truly like a market incentive in terms of applying market forces to this process. They were kind of like government contractors, but it was all written out in statute in a way that was affected by special interests and unnecessarily rigid. So in our view, moving to the direct loan program was actually one that allowed us to apply more market forces to the administration of this program, in the sense that it allowed us to raise capital through the Treasury, which saved significant amounts of funds, and it allowed us to administer the contracts in a competitive, performance-based way that was a little more nuanced and allows us to improve the level of service that we offer to students. So that was the long-term policy objective. And by moving to the program, we saved something like $60 billion, which we were able to reinvest in Pell Grants, community colleges, and other worthwhile things. The short-term reason was this was happening at the height of the financial crisis. And at the time, the lenders were unable to locate the capital to guarantee access to student loans for students. And so even before President Obama was sworn in, you already had seen steps taken by the previous administration to expand capacity at the direct loan program and schools coming in. And so at that particular moment, the federal government was the only one who was able to ensure the continued functioning of the student loan programs, and that definitely contributed to the debate.
And kind of speaking of the financial crisis, I thought it was really interesting, kind of the comparison to student debt and the housing market crash. So can you kind of flesh out that analogy a little bit more?
Yeah, early on in the Obama administration, President Obama set a goal for the nation to lead the world in college attainment. And I think there's a similarity between sort of that goal and the earlier goal, maybe it was the Bush administration, for, increase the number of people who have homes. Both were sort of seen as this very safe, secure investment. It would help the economy, it would help families, it would help people build wealth. And so the focus was on how to expand access versus focusing more on, I'll just raise the question, should everyone be going to college? And that's like sort of a very bad question to ask people these days. I mean, even after this experience that we've had over the past 10 years, there's still this conventional wisdom that everyone should go to college, it's always worth it. And that used to be the wisdom in the housing market, which is everyone should get a house, it's always worth it. And I don't want to dissuade people from going to college. I need to be very careful here. I'm not, saying that going to college is as risky as buying a house, although there are a lot of risks. And so I think there's a parallel with, incentivizing people to go to school, encouraging them to, and then providing a lot of easy access to credit to do so. without really focusing on the ability of those people to repay, whether it was in housing or in higher education. I think we're seeing the same problems. One of the interesting things I found out a couple years ago when I was reporting on the Parent Plus program, I had Equifax, get back to me with how many consumers actually had subprime credit scores over the past 10 years that took on student loans, and it was almost 40%. And I had them X out the number. I had them X out people who didn't have a credit score because I didn't want to include 18-year-olds who don't have enough credit to have a score. Nearly 40% of people who took on student loans in the past 10 years had subprime credit. And lo and behold, credit scores are one of the biggest predictors of who defaults. So there is a parallel here between giving loans to a group of people who we know are very, very likely to default on their loans. And let's just not look at credit score. Let's look at the schools that they're going to. There are all these factors that tell us or tell the Congress or tell the education department, this person is very unlikely to pay back, and yet the policy is to continue to give them loans. And this is, a lot of what happened during the housing crisis. And that still happens to this day. So I think that there's definitely a parallel. I don't think it's the exact same. And again, I think the intentions are good. But I still see all the time, I see college is worth it. And then I always say, well, what college? Well, studying what? At what price? Those questions still aren't asked. I mean, it's still this conventional wisdom. College is always worth it. Go to college.
So, audience, start thinking of your questions. I have one more question for James, and then we'll open up the floor. So, kind of along the lines of college is always worth it and an increasing access, there is kind of the thought of we have to think about what colleges we're increasing access to. And the Obama administration kind of led this big crackdown on for-profit colleges. And so I guess, can you kind of talk about some of the efforts to hold colleges accountable for kind of their outcomes and some of their metrics?
Sure, glad to. And, I think, I agree in part with Josh. I think it is important to keep in mind that college overall remains an excellent investment for students, and that, we see in the Raj Chetty research that colleges that get good outcomes from students from all incomes. We know from places like CUNY ASAP and some of the developmental education reforms that colleges can succeed with students at different levels of academic preparation. So I think it is very healthy to have the conversation that Josh is beginning here, where we focus on students for whom student loans are not paying off. But we need to be able to keep in mind that student loans are a great investment overall for most students, and that we can improve the outcomes of students. The answer is not to close the doors. And I think one of the, probably the most visible effort that we made in the previous administration was the gainful employment rule, which applied to occupational training programs. And we said, look, there's a lot of debate about what people are trying to get out of different kinds of higher education programs. But if you're going to an occupational program, if you're trying to get a job, we can measure whether you have a job, and we can measure whether that student loan investment was worth it. And so what the gainful employment rule does is it takes looks at each program separately, and it looks at typical graduates' earnings and compares it to a typical graduate's debt load. And if those debt load is larger, significantly larger than those recommended by experts, then the program needs to improve or close down. We've seen the new administration revisit that rule, and they've delayed it a couple of times and have begun the process of rewriting it. We should see in the next couple of weeks what their actual proposal is. They sort of floated ideas, but there will be something that they stand behind very soon. I think our view is that, my view is that the evidence behind this rule is even stronger now than it was when we began this process 9 years ago. And you have very well documented evidence of students not being able to repay their loans. Stephanie Cellini at George Washington found that if you incorporate student debt, the students at for-profit certificate programs are actually left worse off they would have been better off not going to college at all. And then you also see, at many of these programs, they have achieved what we hoped for, which is that they have improved. And you see costs coming down. You see free trial periods. You see closer alignment to labor markets. So, the rule does seem to be driving improvement in the options available to students.
Can I just add on to that? I would agree with everything you said in terms of what I've seen. But I've never really gotten a straight answer about why gainful employment should not apply across higher education, because right now it only applies to for-profit schools and trade programs at public schools. But there's a lot of public schools, non-trade programs that would fail under gainful employment, and the only answer I would get from the Obama administration when I ask this is, well, that's how the law was written. So I'll just ask you, do you think it should apply across higher ed?
I don't know. I mean, I think that it is. I think that it is not flip to say that Congress long ago distinguished between occupational programs and traditional higher education.
But the Obama administration did propose things in its budget to change the law. It never proposed changing that.
That's true. But there is a longstanding distinction was not made by the Obama administration that said occupational training programs are about the ROI as measured by getting a good job. And when we looked at some of the broader segments of higher education in the context of the college scorecard, for example, there's a lot of different ways for colleges to be successful. Colleges, colleges that have excellent employment outcomes, you can say they're very good at producing value for their students. If you look at the schools on the bottom of the list, they tend to be rabbinical schools, liberal arts colleges that send students to graduate programs. They're not trying to be places that produce large earning gains, and I doubt that anyone is really confused about that. So you could have a conversation about how the federal programs relate to that, but I think the answers there are much less clear and much more difficult than they are with a program whose stated purpose is to get someone a job.
But then that seems to contradict this message that there's a return on investment for college, and college is worth it. So if college is worth it, and the schools are pitching this, go to our college, you're going to get this big return on the investment. Then why shouldn't they be held to account for whether they're providing that return on the investment? I sort of hear two things from the schools. It's, oh yeah, you go here and you're going to end up with a great job, and then it's like, oh well, don't apply a number to the value that we're providing you. It's like, well, what way do you want? Which one do you want?
I think you need to be, having spent a little time thinking about this, I think you need to be careful about painting with a broad brush. And there are universities that provide, that are highly selective, highly resourced, provide excellent education to the folks that they enroll, and there's value in that. There are other institutions that are affordable and enroll student bodies that look like them and tend not to have as high graduation rates, but are the places that significantly build the middle class. So, our system is very diverse. They're all eligible for the student aid programs. And when you think about what makes programs good, what makes colleges good, you have to be a little bit careful to respect that diversity.
I would just say one thing. I know you want to open it up. Is that I think both of you are right. I think the one thing that I would say to James is I'm not sure that you made a comment that there's no confusion. There's often not confusion about what is maybe somebody going to a liberal arts college understands that what they're going to get is a liberal arts education, and they're not there to get a job, and they're going to go on a graduate school. I don't think that is necessarily accurate. And so in some sense, I think it just begs, and I know you're supportive of it as well, it just begs for the kind of information that we don't have at the program level by most institutions, that at least, you can be agnostic about the choices that people make, but if you tell them, right, like, okay, most people that go to this institution, you may get out, but you're probably going to go to grad school or you're going to go to whatever. People don't either, go into jobs or they don't get jobs in the fields in which they study and all of those sorts of things. I think it's just a valuable information, and And, my personal opinion is, Gameful should apply to everybody.
And so we could go down this line for a while, but I'm going to open it up to the floor. If anyone has questions.
We have one from online we can start with. In the previous panel, the panelists talked about who's struggling with their debt. As you've discussed, there are several sets of solutions that were introduced and expanded under the last two administrations through income-driven repayment programs. But data indicate millions of borrowers are not accessing these options that can support their long-term payment success. Why do you think that is?
Again, I love being a reporter because I talk to people and get the answer. A lot of people, and again, this is just who I talk to, so we need to keep that in mind. I'm only talking to a certain subset. Don't feel like they should pay back a dime. They feel like they were screwed over by their schools. They feel like they didn't get what they intended to get. And they say, why should I pay back anything? I actually used to live with a guy who he got a call, 10 or 15 years later after the fact at his work saying, this is the IRS, we're going to start to take some money out of your paycheck for your student loan. And he knew it. He knew he had owed it, but he just put it in the back of his mind. He was part of a subset of people who they live paycheck to paycheck. They pay their cable bill if they have that. They pay their rent if they have that. They pay their car note. And the education department is sort of on the bottom of that list. And either because they don't feel like they have to or because they're just so worried about making ends meet, they put it out of their mind. So my experience is, yes, I think some people might not be aware of income-driven repayment, but other people are just like, you know what, I'll deal with it when I'm forced to.
I think servicers try to do a really good job of laying out all these options. I think there are a lot of options for I don't know what the number is now, 50, 80, something? I don't know, some ridiculously large number of ways in which you can repay your loans. And I think servicers try to do their best to help people and I think there are some, maybe there are some barriers to what they can do to help to get folks in that. And and I think sometimes it's just, you don't get a response. You can only do as much as you can do to get people to respond. So it's an issue.
Yeah. And Deborah, actually, do you know the number on that one, Deborah?
I know there are eight on the FSA website. There are 8 different repayment plans, and there are all kinds of unemployment, forbearances, hardships, and all kinds of other options.
That's probably what you're thinking of, all the different
I was thinking of all of the different ones in between. There's just, it's a very long list.
Oh, we have one right here.
I'm Frank Bowman with the state grant programs again. And I want to ask a panel a question about market signals. So in Virginia and several other states, a high school senior can go online and see, let's say I'm thinking about majoring in either history or engineering. I can see at any school I'm considering what the average starting salary is for those two fields. So that sort of gives me an idea of what I might expect if I graduate with that degree. And nationally, state grant programs give away $11 billion in state grant aid every year, but over 3/4 of it goes to students attending public institutions, another 27% to private, and only about 2% goes to students at for-profit colleges, which is a market signal saying in many states, we will not give you a penny to go to the for-profit school. We will give you $5,000 if you want to go to the public school. So one's going to clear market signal that maybe this school is something you should think about more than others. But at the federal level, I can get a $5,900 grant and this is using data from 2 years ago, to go to Corinthian or to Harvard. I'm getting the exact same amount of money to go to one of the best schools in the country or one of the worst. So there's no market signal at the federal level in terms of what we should be doing. And Cheryl's members have over 6 million jobs they can't fill nationally. I would think that they might be match funding scholarships at schools saying, if you go to this school and major in this field, I'll hire you and then I'll tear up my income share agreement with you or something like that. So I'm curious what sorts of market signals the panel thinks the federal programs could provide to ensure students who are 18 years old, unsophisticated investors about to make the biggest investment in their lives, how you can help them make the right decision.
Does anyone want to take that quickly?
I don't know. Yes, I'm all for transparency and for, having consumers have as much information as they can to the return on the investment that they're going to have. But I don't know how much that's going to help an 18-year-old avoid the problems that we're seeing. And number two, with income-based repayment, it sort of takes the balance out of their mind, out of the thought process. Because if you're taking away, if you're going to pay 10% of your income regardless of the balance, then why do you care about what the balance is? So, again, I think there needs to be a more holistic approach than just providing that information. I'm all for providing that information, but do I think that that's actually going to solve some of these problems that we've laid out? I have to be honest with you, I'm doubtful.
And I think in some ways it comes back to this quality issue and how do we get at the issue of quality and higher education across? Like, what are those indicators? What are those things that we want to suggest point to a quality institution? And I don't think there's necessarily consensus around what those pieces are. If you're working at the chamber like I do, I care about whether you get a job. And that, to me, would be an indication. I mean, we've said it several times about various institutions. It's a really great school. It's quality school. They do really well. Well, is it? I mean, I'm not really sure. Based on what? And yeah, in some states, like Virginia, it do really well with those, with that level of data and transparency and consumer information about what you can expect at the program level, not at the institution level. Institution level is basically meaningless. At the program level, what you're studying. But those are pretty few and far between. States are really willing. Everybody has it. Everybody could do it. It's a question of whether they're willing to make that kind of information public. And we did a program at the chamber where we did this in conjunction with states, and we went to 4 states. We probably could have gone to a handful more, but we went to the states that were willing to provide that level of data and that level of transparency to students.
James, any closing thoughts?
Frank, we looked at something pretty similar to this in the college ratings plan, and we ultimately decided that it was too difficult to identify good colleges, in part because of the issues that Josh and I just discussed, and also because colleges themselves are so large and diverse that there's a lot going on, from the research of Tony Carnevale and Mark Schneider and others, that variation in employment outcomes within a college is often greater than from college to college. So, I think that, I'm all for employer scholarships if Cheryl can make that happen. But I think that what we should be working toward as a community is trying to improve those measurements of graduation rates, employment outcomes, learning outcomes, civic outcomes, and try and get to a point where we can say, more meaningful things about the experience that a student is likely to have.
So this is it's a big, complex topic, and of course we could talk about it all day, but I just wanted to thank our panel, Cheryl, James, Josh, thanks so much for joining us.
Okay, and we're going to take about a 5-minute break right now to keep the trains running on time. We're going to try to get back around 11:05. Thanks.
would be great. Thank you. Okay.
Okay, so welcome back, everybody, for panel number 3, where we're going to talk about where we go from here. I am Phil Olaf with the Pew Charitable Trust. Thanks so much to everybody for being here. Like Sarah did a little bit before, I'm going to just take a couple minutes out of our regularly scheduled programming to give you a bit of a better sense of, to build on what Travis said earlier and give you a little bit of a better sense of the kind of really in-depth student research, loan research we're going to be doing here at Pew over the next few years. The purpose of this research is really to try to help bring borrower voices into the conversation around default, and as Travis mentioned, veterans borrowing, but to do so in a way that gets beyond anecdote. So if you think about what Adam Looning was saying in the first panel, an example of this would be, the person with a BA who's working as a barista and is $100,000 in debt. This is a person who has very real problems, but may not be representative of the general experience of folks who are struggling with debt. So we're trying to move beyond those individual stories to say something more broadly representative about the borrowers who are struggling the most to pay back their loans and about veterans who are borrowing for their education. And the way we're going to try to do that is by engaging with borrowers directly, kind of through a two-step process. First, we're going to be doing some very intensive qualitative research, in-depth interviews, and focus groups to kind of bring out the stories of a broad range of borrowers. And if all goes well, we would use that qualitative data that we collect to then inform a large representative survey. So that's the goal. Ultimately, this is and we'll be writing reports on these things along the way. So look out for that. I mean, this is really work that builds on great work that's been done on student loans, including by many in this room, and tries to take a bit of a deeper dive into why we see the borrowing and repayment patterns that we do. I also just want to briefly mention and kind of build on what Travis said, that this project is something that builds both on expertise Pew has developed in family economic security and studying families' balance sheets, but it also builds on work that we've done over the last few years trying to illuminate and untangle the varied set of funding supports that both the federal government and the states provide for education, higher education. And in the spirit of that work, we're actually working on updating a chart book that we wrote a few years back that really lays out kind of the big picture overview of the tangled web of programs that both the federal government and the states offer, walks through the very dramatic changes we've seen in those funding streams in recent years, and talks about the significant variation in the mix of federal and state funding streams across states. So look out for that in the near future as well. So that's all I want to say about our work. I now want to introduce our moderator for the third panel, Jillian Berman. Jillian is a reporter at MarketWatch, where her work actually focuses on student loans. Prior to MarketWatch, she was a business reporter for HuffPost, and her work has appeared in a wide range of major national publications such as USA Today, Bloomberg, and the Wall Street Journal. So we're really thrilled to have Jillian here. Thanks so much for joining us, and I'm going to turn it over to you.
Great. All right. Well, thank you for having me, and thanks everyone for sticking around for this third panel. I was saying to the panelists before, we got a good setup from the first two, sort of what are the problems, depending on your perspective, how did those problems start? And then this panel hopefully will be, a little more feel good. We're going to focus on some solutions and some ways forward. So with that, I'm going to introduce the panelists, and I'll give them a brief introduction, but they'll share their perspective, I'm sure, a little more as we get going. So to my direct left is Matt. He is the director of the Urban Institute's Education Policy Program, and he's also written 2 books that are really relevant to this discussion, Game of Loans, The Rhetoric and Reality of Student Debt, and Crossing the Finish Line, Completing College at America's Public Universities. And then next to him, we have Julie, who's a fellow at the Roosevelt Institute, and before that, she served as a senior program officer at the Bill and Melinda Gates Foundation, and has worked as a senior policy advisor to Senator Elizabeth Warren, where she worked on education issues. So again, very relevant. And then next to her, we have Scott, who's the senior vice president and director of federal relations for the Pennsylvania Higher Education Assistance Agency, which many of you around here may know as by its acronym FIA. We heard a lot about student loan servicers before, and so Scott's organization, FIA, is one of the 4 major student loan servicers that works with the federal government to manage its portfolio. And then next to him, we have Daniel, who is an assistant vice president for government relations at the American Council on Education, which is an association that represents colleges and universities. So a lot of different perspectives on how we go forward here. So I'm going to start with Matt first. So from a research standpoint, what do we know about, sort of what is working and what's not working when we're looking to address the student loan problems that we see?
So I think, there's obviously a lot of issues in student lending in the United States. But I think it is important to acknowledge that kind of the fundamentals of the system are basically right, and it's sort of the kind of details that are wrong and are causing a lot of problems. So on the fundamentals, I'd first say, well, we have a student loan program, we have a federal loan program that corrects a really important market failure, which is that there's a lot of students in this country who wouldn't be able to go to college, but for a source of financial support from the government. We know that the grant programs aren't enough. And there's a lot of people who aren't able to cover the remaining costs, both direct costs for tuition and living expenses, out of their current income, out of their assets. So it's really important to acknowledge we have a federal loan program. That's sort of the right thing, right? There's no one out there saying we shouldn't have a federal loan program. And then second, we have in place kind of the basic framework for an insurance mechanism, right? For the fact that student loans aren't a traditional loan where you borrow and if it doesn't work out, they come take your house, you declare bankruptcy or whatever. It's this sort of weird thing where it's based on a promise to pay in the future. And for the main program, that's 90% of the market, there is an insurance mechanism in the form of a whole bunch of income-driven repayment plans where you don't just pay a fixed monthly payment, you pay a percentage of your income. So that's basically the right setup, right? I don't think there's anyone or any serious person who thinks we should kind of blow that up and not do a loan program anymore for people who can't pay. But it fails too many people in practice. And so we have this program, and it's available to everybody, which is basically right. But it's available to anybody to kind of go anywhere, to do anything within limits that are probably too broad. So as a result, there are too many people who are borrowing for degrees or credentials that ultimately don't pay off, either because the degree or credential doesn't pay off or because they never get it in the first place. And second, the insurance mechanism, income-driven repayment, fails because it doesn't work for those who need it the most. It doesn't work most for people who, in moments of financial hardship, are unable to navigate a very complex set of programs and kind of make the right decision or even know that those programs exist in the first place. A colleague and I were just talking before about how services often have to make hundreds of calls to people, especially who are behind on the loans, to get someone to return their call. And it sort of occurred to me, well, if I were in that position, and I didn't know much about these programs, would I be able to tell the difference between a scam? Right. Hey, you don't have to pay your student loans anymore. That could describe a scam, or that could describe our income-driven repayment programs. So the fact that you kind of have to be proactive to get into them, and they're not automatic in the way they are in places like England and Australia, I think means that they work in theory, but they don't work in practice.
Yeah. And Julie, when when you're hearing from borrowers, sort of what are some of the things that they're dealing with that that you're most concerned about from a sort of from a going forward perspective, or things that might be ripe for fixing?
Yeah, so I think some of the things that I'm most concerned about are, number one, I get that, Matt says like no serious person would want to rethink the whole program, but I like to think I'm serious, and I think that, we really need to think about the aims of the federal government's role in federal student aid and what we're getting out of it. So not when we invented the loan program, but when the federal government decided to engage in federal student aid, we were trying to help people who did not traditionally have access to college, right? And we had our first panel sit up here and say the students who are having the most difficulty repaying their debt are the people who we most wanted to help. So I think from that perspective, it does make me worry that we're thinking about the problem incorrectly, or we're not being critical enough of the system just because a lot of people are able to repay their debt. I think the other thing I worry about is the disconnect between what we hear from borrowers in terms of their struggles repaying their debt and the way we think about what it means to be in trouble on your loan. So we sort of say, default is a problem, delinquency is a problem, repayment. We don't just say it's not a problem, we say that means it was a great investment, right? To me, we need to be really critical of that space there where students are saying they're having a problem, but we are in our, when we're alone at our computers with our data, are saying there's no problem here if students are repaying their debt. And I think that means looking at measures outside of just repayment, but the overall effects on the economy, people's ability to build wealth and do the things that they thought they were going to do when they got an education.
Yeah. And Scott, for you, I mean, you're coming from a perspective of a servicer dealing with, a lot of borrowers. I mean, what are some of the biggest obstacles that you see to servicers sort of helping and working with borrowers?
Sure. Let me just digress for half a second and just thank Pew for doing this, not only for today's session, but for diving into the wide world of student loans. This is an area that's in dire need of real research from like the servicing side and what does it mean and what works and what doesn't work. And I'm really looking forward to the work that Pew is doing here. So I didn't want to go without saying that. FIA is a student loan servicer. We're also a state grant agency and a higher education assistance agency and all those things. But I'll talk from the servicing point of view. One of the challenges that we're facing and trying to figure out how to solve and as we try to assist borrowers is how to reach them and how to sort of get them engaged with their student loan and with their student loan repayment. We've all heard and we all know how complex the system is. So how is it that you sort of bring borrowers in to that system and have them work with it? Right now you have a student loan servicing model that is the same as it's been for 50 years, and it's based on the premise that unless a borrower is in trouble, they don't need to talk to us. When they get delinquent, when they get behind, when they get a notice from us that says you missed a payment or there's some problem, that's when they're prompted to talk to us. We're kind of looking internally through our customer experience folks, how do we get borrowers to reach out at other times? What are other times in their life or in times in their student loan journey, as our folks like to call it, in which they would benefit from being proactive about their student loan? It's not as simple as, well, let's just wait until you have some trouble and then we'll try to dive in, which is how the whole student loan system is sort of based on, what the federal contract is kind of based on. There has to be a better way to get students more engaged. We're talking about trying to reach millennials, Gen Xers, Gen Zers, all of these people, but also remember, we got parents, we got people like Dan and me, out there, our age, and you have to have some ability to communicate with us too. So we're looking at trying to figure out what's the next best way and how do we get out to students and also, like I said, get them in addition to us just going out.
And actually, one point that Matt brought up earlier, the kind of the
scam
point, is that, sort of, is that something that you guys experience, and how do you?
Oh yeah, it's yes, and it's troubling because folks out there are imitating student loan servicers or imitating the federal government, getting folks to pay money for services that they should be able to get for free, taking payments which borrowers think are intended for their student loan and keeping them and not forwarding on to the student loan servicer. I think there's a messaging issue out there in terms of there has been a little bit of noise about student services are bad and they're not helpful to you and they may not be the place you go, and that's given the field a little bit to these guys, to these services. But we do try, as soon as there are things we do to try to identify who's engaged with them, and if we have large groups of borrowers engaged with them, and then as soon as we learn that they've been engaged with them, we try to get them disengaged as quick as possible. But they're fairly relentless, and they do, call and have, caller IDs that say, student loan servicing, and that immediately creates issues in terms of who you're going to believe, who's on the phone.
And Daniel, I'm wondering, from your perspective, what are some of the things that your members are, most worried about in the student loan repayment process?
Well, I think you go back a couple of years where ACE, at the request of Senators Alexander, Mikulski, Burr, and Bennett, convened and staffed a panel of 16 college and university presidents to look at regulation of higher education. So it was a panel co-chaired by Nick Zeppos, the Chancellor of Vanderbilt, and Britt Kerwin of the University of Maryland. And so we did that for about a year or so, had some field hearings, and came up with 10 recommendations, one of which was simplify the student loan repayment process. Why do we have 5 income something repayment plans? Why do we really have a graduate payment when hardly anybody uses it? So that has been, where our membership has been on the back end. Our membership has also been involved, I know it's not part of the discussion here, but front end issues like, should you really be giving a student loan to a student who's taken 2 remedial courses? Something like that. But again, the context of simplification. And also, but looking forward, because we do have a movement. So you see it in the Prosper Act, originated by the department a couple of years ago. This notion of repayment rates, a move from default rate as a metrics to a failure rate to a success rate, repayment rate. So you don't have to get too far over your skis to think about sort of student loan repayment, and then sort of how that fits in with a scheme, a likely scheme at some point in the future where there'll be an accountability metric based on repayment rates. So that's kind of where we are. I just wanted to quickly follow up on something Scott said, since I spent some time on the inside at the Department of Education. And Scott talks about servicing or contacting borrowers when there's a problem. And this gets back to the rich culture, history, and tradition of federal student loans, where servicing was about maintaining the guarantee on the loan. It's about private lenders maintaining their non-repayment, default, death, disability insurance. And that's why you have these specific prescriptions around when somebody misses a payment. I don't know, you call them up, you send them a telegram, Pony Express goes out, I don't know. But at any rate, he is absolutely correct that we have this 50-year-old system that is still in place, that is just crying out for modernization.
Yeah, well, and so that gets to, another thing that I wanted to ask you all about, which was, to what extent are sort of these problems that, that you guys all brought up a function of, the design of the program, and to what extent are they, a challenge of sort of things that we can't control, or, bad actors, or, or things like that. Sort of how do those play together to get to where we are?
Do you want me to go first? I think, I think a lot of it relates back to the design of the overall program and how we think about the federal government's role in higher ed. But I think just on the servicing and default piece, I would say that we don't necessarily have the data that we need to understand what role servicers can play and how much we should expect of them in mitigating delinquency and default. I don't know if you agree, but it strikes me that we've heard, I worry a little bit when we hear about the connection between borrowing and attending for-profit colleges, because of course there's a correlation there, right? But we don't want to necessarily let the servicers off the hook for being able to mitigate some of that. So how do we figure out what's the appropriate balance there?
Yeah, and you make a really good point, which is, one time they arrive at the servicer, the die is cast in some cases, or the package is assembled, right? They come to us with their full debt load, with whatever collegiate or non-collegiate experience they've had that got them there. And then we, as servicers, attempt as best we can, within lots of wonderful federal restrictions, not that I'm blaming Dan for any of those, that, and try to work with the borrower and try to work, but there is a set of people that come in who will manage repayment joyfully and happily and have their amount debited every month, and will sail off into full repayment, and if satisfy the loan, and that's fine. And there's a subset of folks that will come in, and it will be a struggle. And it will be an absolute struggle, and everybody here, in the prior panels has mentioned all those reasons. They didn't get the education they expected. They're not getting the outcome from the education that they anticipated. They didn't complete the education. All of those challenges, and there really isn't, and it's really one of the things I'm looking, at the Pew folks to teach us better is, what is it? What are the ways that those borrowers will react and will be able to work better within the system that they're working in. And as servicers, we're challenged on the other side, which is to say, can we figure out who those folks are early enough? And can we engage with them early enough? And somebody made the point, too, there are folks that just don't want to be engaged with. And it's an issue for every creditor in every form of credit. And it happens, too. And so we're sort of, trying to deal the cards and figure out which ones we want to play and which ones we're able to play successfully and which ones take more effort and which ones take less effort because you're trying to balance everything.
Right, so when we talk about the pool of students who are attending for-profit colleges, you get into this world of discharges that are more likely to be available, so closed school discharges or defense. These are things where the Department of Education either knows or it is knowable what discharges a student might be available for. So I think it would be helpful for the public to understand, how servicers are reaching out to borrowers on those issues versus just kind of like letting them repay and waiting for them to reach out. Yeah.
Well, in terms of program design, and I'll pivot it over to the income-based part of it. We had an income contingent demonstration loan program authorized in the 86 amendments with 10 institutions, Loyola Chicago, University of Missouri, Rolla, Metropolitan State in Denver, and if I stare at the ceiling long enough, I'll come up with the other, Brown University. But at any rate, it was a 5-year demo. We ran it for 4 years at the department because we learned the one thing we needed to know. So people won't tell you what their income is. So a few years later, when we were bringing up the direct loan program and regulating the income contingent repayment plan, and because we had forgiveness on the back end, 25 years, it was critical to get good income information. And good income information is IRS. And sadly, then as now, the IRS will not automatically give that to third parties. So the individual has to authorize that or otherwise apply. But this notion of, this gold standard of income determination that underlies the program, is, I think, in large measure, a reason we don't have a better take-up rate on the various flavors of IBR that we have out there.
Yeah. So now, we're supposed to be talking about solutions, so I will pivot to solutions. And one thing I want to, just ask each of you is to talk a little bit about, a solution could be big or small policy fix that you think would be useful. And then if you could also speak to what is stopping this right now from being implemented. So, we're in the midst of, sort of a redesign of how the student loan servicing system is going to work. We've already talked a little bit about how Congress is thinking more about how, higher education and student loans are going to work. So, to people who are thinking about those things, tell them why we need your fix and what they can do to make it happen. You want to start with Matt?
Sure. So I think the two big things are kind of go back to the sort of two pieces that I talked about. We need to fix who is eligible to get, not individual students, what institutions or programs everyone to think about are eligible to get federal money, because people aren't spending their own dollars. It's not this market that works. They're spending federal taxpayers' dollars, and they're spending some of their own money that in theory they have to pay back, but in some cases they're not going to pay it back. So there's not some easy formula that, here's what you do, and that solves the problem. It's like hard to figure out what are the places that are bad versus the places that are just enrolling students that they don't always have the greatest outcomes and that come from challenging backgrounds, but we want to give chances to. So it's not an easy thing to do, but there needs to be some high water mark that probably excludes a lot more institutions than are excluded today. Politically, that's hard because no one wants to exclude those places. And how do you deal with the fact, how do you differentiate between a for-profit college that's providing a good service, but to students who don't always have great outcomes, and a for-profit college that's providing a bad service, and maybe a historically black college and university that is doing a good job, but is educating students from predominantly African-American backgrounds that for lots of historical reasons don't have the kinds of assets that would insulate other students from defaulting later. So how do you, that's the challenge to doing it, but clearly you kind of have to do it. And then the second one is that if, I think the reason that we can sort of accept the loan program when there's no collaterals because of this insurance mechanism against unaffordable payments. And so the fix there is to move to an Australian-style system where it is automatic. And not automatic in the sense that you sign up to have it debited from your debit card every month and save a little bit on your interest rate, but automatic in the sense that it's withheld from your taxes, from your pay every week in the same way that your income taxes are. So that when you lose your job, you don't have to figure out how to navigate these programs and know to call your servicer, know this program exists. You just stop paying your payments, your student loan payments, the same way you stop making your payments, your taxes. The reason that's hard to do is because A, there's a bunch of logistical things that just make it hard to design it in practice. Especially because we have an income tax system that taxes families, not individuals, which some other countries do. So there's some sort of details to be worked out. And then, I think administratively, it obviously imposes some burden on employers. You have to figure out how to deal with the people who are self-employed or who are in the gig economy or all these other things, which aren't reasons to say you can't do it. They just make it harder. And then I think politically, I imagine there's people who maybe don't want the government dipping into their paycheck every week to make them pay their student loans, even if you have the right income exemption and do all those things to design it right. So it's kind of hard to imagine a politician out there running for office saying we're going to get your student loan payments one way or another. But the truth is the government's already doing this, right? We're already garnishing people's wages. We're taking their income tax credits. We're taking their occupational licenses. So we have a system that basically does this in just a really punitive way. So I think it makes a lot of sense to do something that serves the same function, but in a less punitive way, in a more fair way, but it'll be politically hard to do it.
Can I do two?
Yes.
Is that okay? Okay,
Yes.
because I have.
I do too, so
allow
you
it.
get two.
Okay.
One up, maybe three.
Yeah.
Shoot, I don't know if I have a third. I want to talk about one that's sort of like high level, far ranging, and one that's like a very, do this now fix. But both of them fit into this frame, I think, of what is fair and what we sort of owe to student loan borrowers and to our country as a whole. So I think the first one is that we need to be talking about large-scale student loan discharges in a more serious way, and that I know there are people out there who are saying get rid of all of the debt. There are people out there who are saying get rid of some portion of it, but I do think that we need to have a more serious conversation about whether or not this student loan program has failed borrowers for a variety of different reasons that are not based on their individual involvement. They played by the rules. They did what they thought we were telling them to do, and because well-meaning policymakers misjudged how the economy works, how the student loan market works, how higher education works, they've ended up with a lot of debt. So I think we need to have a more serious conversation about the effects on the economy as a whole and on those individual borrowers. So that's my wish, far-ranging. And then my more sort of short-term wish is that we provided more ways for individual borrowers to challenge the actions of their servicers. Right now, we treat student loan servicing problems as a policy problem, where so if we see a pattern of the same people having the same problems, we go to the Department of somebody, I don't know who, like once there's enough uproar about it, it goes to the Department of Education and they make a policy choice. And, in my mind, sad to say, I think more often than not, they side with the servicers over the borrowers, and we have a paper at Roosevelt about that coming out. There's not a lot of recourse for an individual borrower who has an individual problem that they want to get addressed. And we've seen in the past when those borrowers have, at great expense and time, gone to court to try to get resolution, there have been servicers that have done everything they can to wriggle out of responsibility. And so my small-term solution would be that we would find a way to incorporate into the student loan program appeals processes and other processes for individual borrowers to seek redress when it's a problem that just affects them.
So one, like, really in the weeds suggestion. When Congress implements new policies and new policy changes for student loans, they often do it for new borrowers. So folks who have no debt yet and are going to take out their first loan sometime after. And what that creates is a cohort of folks that have a certain package of benefits whose loans look a certain way, but look different from prior cohorts of borrowers. My little Christmas wish is that Congress stop doing new borrowers and just says, for everybody going forward, it's going to look this way. And I agree with what Joanna said earlier, that there are benefits to borrowers from having choices in repayment plans, because we know that there are, somebody said before that nobody uses graduate repayment. Well, we know people use graduate repayment and that it helps them through periods of time. But we also know that borrowers come in confused because they don't know which programs their particular loan is eligible for, and that in order to get them there, you've got to go through the laundry list of every program, and it would be much better to say, everybody, here's what everybody's eligible for, and it would pare down the list and add simplicity. So that's my short-term, really in the weeds policy wish, that we just, new borrowers, nobody uses that word anymore.
Yeah, I have a couple as well, and I'll just pick up on what I was talking about before with income-driven repayment and forgiveness, and the importance of having good income information on which to base the amortization, because you have forgiveness at the end, currently either 10, 20, or 25 years. But what if you move to a forgiveness scheme that's, in a sense, calendar-based, like in the Prosper Act. Prosper Act would provide forgiveness after you've paid under their income-driven plan an amount equal to what you would have paid under a standard 10-year fixed payment. So that's kind of a calendar-based. If you have that scheme, how assiduous do you need to be in getting the income on the front end or during the repayment? Because if somebody lowballs their income, they're just going to be paying longer. And if you don't have this burden of getting, authorizing the IRS on, some periodic basis to tell the government or tell the servicer what your income is, perhaps you can get an uptick, and maybe a non-trivial one, in the take-up rate. So this is something that just occurred to me recently. I haven't given it any thought beyond what I've just said here, but might be something worth looking into. The second one is, I knew he would, and Matt stole my thunder on the payroll deduction. But I'm a big fan of a demonstration of experimentation. And I'm wondering if a short-term approach may be to talk to a firm like ADP. Those guys, they claim they do 22 or 23% of the non-farm payroll in the country, W-2s and that sort of thing, and they have a research arm that produces like monthly jobs reports like 2 or 3 days before the feds do. So if somehow the department through their servicers had some authority to contract with an organization like ADP to do some sort of feasibility test, experimentation, something like that, to see if the Australia model might have some chance here. And again, because if you don't have a paycheck, you're not getting anything withdrawn. In terms of the self-employed, if this goes to scale, there's quarterly 1099 reporting to the IRS. The government and FIA have powerful computers and clever programmers. I'm sure they can figure that out.
Yeah, and just to make sure, I don't know how many people are familiar with what Australia does to collect student loans, but Matt, can you just talk, briefly about that, because it's been mentioned a couple times, kind of how that's different from how we do it here?
Yeah, so the basic idea is there's no servicers, sorry. But there's a government agency that, you borrow up to certain limits. I don't think you can borrow for living expenses in Australia, so the amounts tend to be low because the other thing you have to realize about other countries is that a lot of their higher education systems are just much more regulated. So it's not this free-for-all we have in the U.S. It's there's some set of public institutions, and tuition is capped. So you borrow some amount. I think the typical borrowing amounts aren't particularly high, maybe $20,000 or $30,000, something like that. And then you pay a percentage of your income. I forget exactly what it is in different countries that do this have different ways of doing it. Some have a sliding scale where it's sort of a progressive percentage, so kind of like our tax code, you pay a higher percentage the farther you go, and it's withdrawn from your pay in the same way your income taxes are withheld, and you pay it until you pay it off.
Yeah, I kind of think about it in terms of FICA withholding, because that's a first dollar kind of tax, and it doesn't, for loan repayment, it doesn't have to be a first dollar, but again, I think this is where some experimentation might be handy.
And the important thing I left out is that you only pay once you get over a threshold. So in some countries, once you make over, say, $40,000 a year, you pay a percentage of your income over $40,000, but then some, and I can't remember which one of these Australia does, have a cliff where once you get over, say, $40,000, you pay a percentage on all your income below it. But the point is there's always an offset, because the whole point is you don't want to be withholding, 10, 15% of someone's income if they're making $5,000 a year, because there's understanding that people need to eat first.
Yeah. Okay. Well, reminder, start thinking of your questions. I think we're going to open it up in a couple of minutes. Before we get to that, I want to do just like a little common student loan fixes, like lightning round discussion of a couple. I'm just going to mention a couple, things that people talk about a lot as ways to deal with the student loan problem. And if you guys can briefly just share your thoughts on them, try to keep it brief. If you don't have a strong opinion, that's fine too. You don't have to share your thoughts. So the first one is allowing federal student loan borrowers to refinance their loans. This is something people have mortgages. They're always talking about, I can refinance my mortgage all the time, but I can't do this with my student loan. And so it's often brought up as a way to make student loans less burdensome. What do we think?
Yes.
Okay.
And the reason yes is because, basically we have all direct loans now. When there are FFEL loans that were financed with bond issuances, that sort of thing, I understand the complications backstream of refinancing. But if it's the feds making the student loans, then absolutely refinancing should be an option.
I would say yes too, so that's great. And I just want to add that, I think this is one of those places where we see a disconnect between what people say in Washington and what average people think. Like, this is just, when it's one of those things that has broad bipartisan support, and I think part of the reason why is because it just strikes at fundamental fairness, right? You can refinance your car loan, you can refinance your mortgage. How can you be stuck with an 8% interest rate on your student loan when other people are getting a much lower rate? And so I think, do it for all of the benefits to the individual borrower, but also do it because it's a step in the right direction of saying the federal student loan program should be the most fair loan program out there for students.
When I think about it, I agree as well, and I don't think a point or so reduction in interest rate is going to solve the student loan problem. But I also think what it creates, when you think about it, it creates another touch point for the borrower to sort of examine where they are. When I went through refinance our mortgage, multiple times, and every time was a sort of a holistic financial touch point, right? It was, I didn't have one, but it would have been a decision, do I want to move from an adjustable rate to a fixed rate? Do I move from a 30-year to a 15-year? Do I want to take money out? Do I want to pay off this mortgage as soon as possible? Do I just want to stretch it out? It allows the borrower a chance, I think, to make those decisions again, decisions that they made, the typical borrower, right? 18 years old, they made the big decision, where am I going to school, which results in how much am I going to borrow. At 21, when they're way more sophisticated, they made the decision on which repayment option is best for me. Do I want the lowest monthly payment? Do I want to pay it off sooner? This would give a sort of a natural point, again, for folks to revisit that decision based on now a whole new set of financial circumstances that they find themselves in.
All right. People can already refinance their loans in the same way that they can their home loans or their auto loans, right? If the market interest rate falls and there's a lender that's thinks it's a good deal to make a loan at that new interest rate, they can do that. So we don't need any legislative solution to do it. So when people say refinancing, what they really want to do is take a loan program that is subsidized by the government. As a result, there are a lot of people who don't have, there's no market for refinancing those loans privately, and they want to lower the interest rate. So they basically just want to increase the subsidy, because if there weren't a subsidy, people would go refinance in the private market, and some people do that. But those are the people for whom they're not getting so much of a subsidy from the government. Maybe the government's actually profiting from them, so they can get a better deal on the private market. So I get why it makes for a nice stump speech, but it's really just a handout to people who have student loans, and it's a handout that's proportional to the size of the loan they have. So if we went out and introduced everyone's mortgage by 1 point, that would benefit the wealthiest people who own the biggest homes, the most expensive homes, with the biggest mortgages. So if we do the same thing for student loans, the fact that the top quarter of the income distribution holds something like 40 or 50% of student debt, I mean, this is sort of Republican tax plan territory. So sort of the politics of it, I think, are sort of interesting. I mean, I think one thing that might make sense going forward is maybe we just ought to go back to having variable rates on these loans, because I get why it's sort of confusing for people that they get a fixed rate loan and then the market interest rates on other things fall, and then it's like, well, why am I paying 6 points on my student loan when I could get a car loan for much less? So, I mean, I guess there's an argument to be made for maybe we should just have the variable loans, because in the current kind of political environment, the market rates fall, and we all talk about refinancing. But let's say the market rates rise, and in 10 years from now, the market rates are 8%, we made a whole bunch of 4% fixed rate loans. Are people going to be out there saying, we need to refinance everyone's loans, we need to raise their interest rates? Well, no one's going to want to do that. So this kind of one-sided refinancing, it just doesn't, I get why it makes for a good stump speech, but it just doesn't make a whole lot of sense.
So I didn't give stump speeches, so I don't have like kind of a dog in that fight. But I think it's remarkable to talk about giving borrowers the best rate we can as a handout to them. I mean, I think it's part of the problem that I have with the way that we talk about student debt in terms of forgiveness rather than discharge for something, right? Like a borrower who works through service to pay off their debt, we're talking about it as forgiveness, and we talk about this as a handout to an individual, when it's really about giving them the best deal that we can and a competitive deal. And I get that some people can refinance in the private market. That's okay for some people, but it requires them to give up a bunch of the benefits of the federal student loan program. And I think if we're talking about making a better federal student loan program, it should be on the table.
All right, we'll do one more before we take questions. This one has been in the news a lot recently. Changing the treatment of student loans in bankruptcy. Anyone?
Private label student loans should be dischargeable in bankruptcy. They have not been since about 2005 because lenders can bake that risk into their offerings up front. I think you have less of an argument for federal student loans because there's no underwriting, except for a little bit on the plus side. But for Stafford loans, there's no underwriting. So.
Got it. Okay. Well, so let's see if anybody. Oh, sorry. Did you have a
yeah, bankruptcy?
Yeah.
Private loans, yes. Public loans, probably not.
I'll leave it to these guys.
Okay. All right. Does anybody? Okay. Yes.
Ted Knudsen, I'm a contributor to Forbes. This is for Scott. He said right now borrowers don't need to contact servicers unless they're in trouble. Well, why should they contact servicers if they're not in trouble, and when?
Well, I think that it's almost the other way. It's we don't generally, I mean, we do reach out to borrowers at all sorts of times and before they start repayment, but the system is, Dan sort of described, is built on how do you prevent delinquency, which is obviously still a critical goal, but there are also other reasons why borrowers would need information and how can you proactively get it out for them. Julie mentioned public service loan forgiveness. It's a program borrowers should be informed about at all sorts of times because they may not go into that straight out of school. It may come up at a later time. They may be, as I kind of indicated too, other financial touch points at which they might want to make different decisions than they made 5 years ago about their student loan, about repayment plan they're in. Somebody earlier mentioned negative amortization. Negative amortization, when you're not paying enough to cover the interest on the loan, that ends up reflecting in your credit report. because you've got a higher outstanding balance. It might be that, as you're dealing with other financial decisions, you all of a sudden, that's an issue for you. Maybe there are times when borrowers should be informed a little bit more about what's going on in their financial life of their student loan than just, hey, you missed a payment.
Any other questions? Yeah.
Savvy, we're a tech startup, thanks. Trying to help people better sort of manage and optimize their loans. So Julie, you had brought up a really good point about losing the protections with by refinancing from federal and going over to private. And I know that I think 90% of the debt is federal at this point. So I'm just wondering your sort of opinion on the future of things like public service loan forgiveness, and also sort of all of the other benefits that you can accrue by staying within the federal system, deferment, forbearance, things like that. And Scott, you had mentioned sort of, treating all borrowers or getting rid of the new borrowers terminology. But as someone, who potentially from the impact of getting rid of PSLF, would be negatively affected. And again, PSLF, they always say would only affect new borrowers if the Trump administration had sort of said that it could get cut. So just sort of your stance on that. But I think just in general, talking more about sort of PSLF and other sort of forgiveness programs that I think are underutilized, maybe how people can better benefit from those.
Yeah, so I like public service loan forgiveness. I think that we should maintain the program. I think the conversation that is going on around public service loan forgiveness and grad students who are taking on increasing levels of debt and looking for cancellation of those debts, I think should be had outside of the context of just PSLF. The question of whether employers are pushing off training onto individuals, making it their responsibility, and we're fueling that through a student debt system, is a really, really important one, but it's more about the shape of the student debt program as a whole than just about PSLF. So I think we should continue that debate outside of PSLF context.
And just to clarify, for people who sort of aren't following super closely, what is the conversation that people are having about grad students in PSLF, versus sort of like the narrative that's out there about what's going on with them versus this sort of bigger question that you're talking about training.
So I think there's, and you guys should feel free to jump in, but I think there's, from the time that the PSLF program was put into place, there's been a conversation about for whom we should discharge debts. Should we limit it to certain types of employment? And then now I think maybe there's a larger conversation going on around whether like the idea of discharging for public service is a good one. I think the Prosper Act probably brings some of that up. But in terms of the graduate student piece, there's been a lot of noise made about how a lot of the people who are getting or looking for public service loan forgiveness are high debt graduate people who got that debt for graduate school. And so there's a question of whether those, essentially employers, law schools, whoever, are using PSLF as a way to load people up with debt and then have the federal government take care of the problem. Is that a good, accurate description?
Yeah, no, I think that, first of all, I want to say in my new borrower comment, I know in no way was implying we should take away PSLF. As more directed at repayment plans and trying to get a usable group of repayment plans going forward that everybody can get their arms around. As FIA, as a state agency in Pennsylvania, we are extremely supportive of the concept of PSLF. We think it is the right thing. We understand that people work in public service, choose a public service career is something the government should encourage. I think it's like sort of to others to determine whether PSLF should stay in its same form. We know the Obama administration proposed some changes, some limitations on forgiveness at the end. Those conversations should be out there. But I think the intrinsic value of having the program exist, FIA as a state agency is a believer.
So can I talk about getting rid of PSLF? I guess I'm the Grinch on these panels, and maybe I should start charging a higher rate or something. But I think the fundamental issue with programs like PSLF is they're just sort of a really inefficient way of subsidizing people who work in certain sectors of the economy. So I kind of get why people are sympathetic to people who work in the public sector, right? They're serving the public. That's a good thing. Maybe we want to encourage that. So it's not really my area, but I could imagine someone saying we ought to provide lower tax rates for people who work in the public sector, some tax credits, or we should somehow recognize that public service isn't rewarded financially the way we think it should be. The problem is that doing it through a loan program is basically saying, okay, we're going to do that, but we're going to do it in a way where the size of the benefit is proportional to how much you borrowed. So if you borrow $10,000 and you go into the public sector and make a middle-class income, you'll probably pay off your loan in 10 years and you don't get anything. So we don't value that kind of public service. But if you borrow $300,000 to become a doctor and happen to work at a public hospitals, and you can kind of game it with a few years of residency, you don't make very much, well, then maybe you'll get a $100,000, not a handout, what's the word?
I don't know.
Whatever your preferred word is, whatever you want to call it. A $100,000 discharge. If you were,
tax liability.
If you borrow a few $100,000, well, not a tax liability on public
PSL.
service because
Yeah,
that's
that's
not
true.
taxed. But
Regular
you borrow a few
ICA.
$100,000 to be a lawyer, and then you have to start thinking about kind of from a fairness perspective. I think is kind of where it bothers me the most, because now someone, a trust fund baby who wants to be a public service lawyer, which is a nice thing. In the past, they would have just paid their law school tuition out of their trust fund. Now they can stack up the debt and get it all forgiven by the federal government. And then you have to worry about the incentives for the institutions, right? If there's now a whole bunch of people, and this is really a problem on the graduate side, I think this is less of an issue on the undergraduate side, who are above this point where, given the income they expect to make in the field they expect to go into, they can borrow as much as they want over that, and they're never going to pay it back. It's just going to be sort of forgiven, discharged. Then you have to worry about the incentives.
We have at least one question online.
Oh, can I just say, I think you're making very good points, and I also think, and I agree with you, and I also think that those things should be thought of in the larger context of the student loan program, not just PSLF, because, so the example I always think about is early education, right? So teachers teaching in an early childhood setting make extremely low salaries. We don't talk about this as much because it's not part of the PSLF debate, but we're doing things like thinking about universal childcare programs or universal pre-K that would require all of those people to have bachelor's degrees, right? With no conversation about what we're going to do about the debt loads that those people have to take on to get the bachelor's degree. So I would rather have the conversation in terms of employer responsibility and public responsibility for educating people in public service fields rather than the individual.
I agree with you about that. I mean, it's crazy that a lot of states force teachers to get master's degrees, which we know empirically are worthless degrees from a kind of productivity standpoint.
I don't know, but you might.
But my K-12 hat on for a second. Maybe not every single one of them is worthless, but on average, people who get master's degree, it doesn't seem to make much of a difference in how much their kids learn. Yet we're requiring them to go take on all this debt. Or in some cases, we're incentivizing them. We're giving them a pay bump, and they know for 10 years it's going to kind of be worth it. So I completely agree with you that there's kind of broader issues that we ought to think about. And there's people who are borrowing for things that they shouldn't be borrowing for.
So this question is good for, I think, everyone. It's a little long, bear with me. The Trump administration has proposed easing administrative burdens on struggling borrowers in a couple ways. One is by allowing the Department of Education to automatically pull borrowers' income data from the IRS for a few years to recertify their eligibility for income-based repayment plans, instead of having the borrower fill out paperwork each year. Another idea is to automatically enroll severely delinquent borrowers into income-driven repayment plans so that they don't default. Are these promising ideas?
Well, I think a bunch of people have talked about the concept of automatic renewal for income-driven repayment by downloading IRS data. It's almost a no-brainer, and it's really frustrating that it hasn't come to fruition for so long. Because getting two federal agencies to work together is a difficult project. So yeah, I think that's feasible. And I, of course, forgot the second one, Rich, so,
Automatically enrolling severely delinquent borrowers?
I think it depends on who they are. I think one of the things you learn about income-driven repayment is it's not a silver bullet, that while about half of borrowers that initially enroll in income-driven have $0 payments, many borrowers have significant monthly payments when they run through the formula. And depending on who they are and where they live and what their circumstance is, that payment is just as difficult as if it was under a standard plan or a graduated plan. So, you have to be careful when assigning. Everyone will be cured if only they had income-driven plans.
But the minimum people would have zero payments, they can't possibly be worse off, right? So if you know someone's income, they're delinquent on their loans, their payments would be zero under IDR, we're probably better off putting them in IDR. right? You're saying people who would have a positive payment maybe couldn't actually afford it, but people with zero payments, should we put them in?
I don't have a particular opinion on that. I mean, you're right, it's a different circumstance when it comes out to zero payment. I think the hope of people when they designed this program, and I remember talking to Dan about it back then, is that people would work themselves through, right? And they might need that help the first few years out, and then their financial lot would improve and they would improve out. You know, as like I said, we find is sometimes they get up to a point where the payment increases faster than their improvement in life or their ability to handle their financial circumstances.
Yeah, I think on questions like this, I defer to people like Joanna who are working with the borrower in that situation, because I think we don't hear enough about the circumstances of those borrowers and how policies like this would affect them. But I do think, you know, thinking about reducing the punitive nature of default on the individual is important. But at the same time, I think, and probably a broken record on this, but not missing out on the other ways to completely cancel the debt, like not using IDR as a replacement for pushing on bankruptcy discharge and total and permanent disability, these kinds of things, I think is really important.
Great. I think that is all the time we have. So thank you all for speaking.
Thank you.
And let's give one more round of applause to everyone who's been on a panel today. Thank you, guys. I have been tasked with providing just a few overarching ideas that I think that we have pulled together from today. So first, what we've heard from on all of our panels is there's not necessarily a student loan crisis, but there may be a repayment crisis. And in fact, there is a repayment crisis for some borrowers. We've talked a little bit about those with low balances, those who are negatively amortizing, and a host of others have been mentioned throughout the day. That repayment options should be flexible and affordable, simple to access and easy to understand, and that the system is complex. And this was an area where there's overwhelming agreement today. But that we still have a lot to learn and a big need for data, especially around default, repayment pathways, the borrower experience, and who is impacted by certain policies. And then finally, and most importantly, that the repayment system needs to be borrower first, which is, I think, a great place to end. We would like to welcome you guys to have lunch with us. There's some lunch here and there's some in the back. And just have some time to have conversations that you guys have started during the breaks today. So thanks.